The judge declared Ripple to be a security when it was marketed to a bunch of institutions, but not a security when it was sold to, I guess, retail investors on an exchange. Is that maybe the first crack in the SEC's, wall against crypto?
I think it very well could be, and there have been multiple examples in the last 2 decades of SEC chairs who have had to step down after an embarrassing loss, like Bloomberg's former board member Arthur Levitt comes to mind. There's also a great history of a change in leadership at these agencies ahead of an election, which we have next year as well. So my personal call is that Gensler will be gone before the next election, and that will facilitate a change in policy here. But there's a lot of steps between here and there.
Is there a physically traded ETF, Bitcoin ETF in Canada?
Yes, Canada, Europe,
so
multiple jurisdictions have approved.
Just focus on Canada. What have we learned? What have we observed about the pros and cons of that maybe the SEC could learn from, maybe?
There have been no cons because ETFs are a time-tested, well-regulated, liquid, and cost-effective way to hold.
Are they treated as security in Canada?
Yes.
Okay. And does here in the US?
The ETF is, not the Bitcoin underlying.
Okay, great. So the ETF is not the Bitcoin. Can that structure, and that's a structure that the SEC is not comfortable with here?
Correct. They object to the, they have a number of objections, and as I said, each one of them has kind of been proven to be logically incoherent, but we're stuck in this mandate, whether it's coming from the president, whether it's coming from Gensler.
All right, so what does this all mean for innovation in crypto in the US? My concern, if I were in senior political levels, it would be, I want to make sure that whatever this crypto thing evolves into, I want the US to be a leader. And now I feel like, just knowing what I know, that perhaps we're not going to take a leadership position because we don't have a well-defined regulatory framework. Whether you like it or not, it doesn't seem like we have one. Is there a risk that the US maybe is not a leader in this business?
That's definitely the path of direction. So we can track the number of developers who are working on these open source blockchains, and we can track them by country. And what we can see is that the U.S. is losing market share of crypto developers. So the innovators are looking to work elsewhere. The other thing that we can see is that stable coins like USDC, which is the Coinbase Circle JV, are losing market share to Tether, which is an offshore, less regulated model on the same.
Now I feel like I'm asking a political question. Should Americans care, and if so, why?
Americans should care because every currency has, there's been no currency that has been the global store of value for multiple centuries. And at some point, the world is looking for an alternative. And here you have a decentralized money where the creation schedule is transparent. And that's very different from what's happening with the Federal Reserve. So we can see what's going on in Argentina.
Ergo the concern, I don't want the dollar to be at risk if I'm President Biden or anybody.
I think what Matt's saying is that the dollar is at risk. So even though you don't like it, we need to prepare for the reality that turns around.
That's it.
We're still a long way off from that, right? I wanted to ask you about other tokens, because other than Bitcoin, people may know Ether, but beyond that, they don't really. I mean, Dogecoin, right? What else is serious and you think really important in crypto that we should be paying attention to?
Yeah, so there are a number of smart contract protocols. These are blockchain software that enable more complex transactions than Bitcoin can enable. So with Bitcoin, it's just very difficult to program in a bunch of if-then conditions and make your Bitcoin move around programmatically. With Ethereum, because of the architecture of the blockchain, that is possible. And there are, a handful of similar layer one smart contract platforms to Ethereum. We're thinking of like a Solana, which make different trade-offs on decentralization and speed. The history of these digital platforms is that they tend to be winner-take-all businesses. We're seeing that in Web 2, Amazon, Google, et cetera. So one of the big challenges for digital investors right now is balancing those winner-take-all characteristics of these digital platforms with the extreme price disparity year-to-date, because year-to-date Bitcoin and ETH are outperforming. Part of the reason why they're outperforming is that the regulator is coming down on all these other innovative platforms. The more that the regulator cracks down, the greater these winner-take-all characteristics will be, the faster they will be. In a way, it's government picking winners. We don't want that. We want innovation to win out.
Sounds reasonable to me. Matt Siegel, thanks so much for joining us here. Matt Siegel, he's head of digital asset research at Van Eck. He's joining us live here in our Bloomberg Interactive Brokers studio. Just looking at Bitcoin because it's on my monitor for whatever reason. It's up 0.6% here, 29,581 for Bitcoin. Right now, let's get world and national news. We'll do that in New York City with Michael Barr.
Paul, Matt, thank you very much. It's 11:33 on Wall Street. Hawaii's governor has warned that scores more people could be found dead following ferocious wildfires on Maui. The blazes destroyed the historic town of Lahaina and are already the deadliest in the U.S. modern history. The toll stands at 96 dead. Thousands have been forced out of their homes, and for those that didn't lose their homes, the area isn't safe because of chemicals and lakes with unclean drinking water. Chris Alloway, Emergency Response Manager for Direct Relief, says it's important to try to get people hygiene products to people who have been displaced.
Folks feel a little bit more at home with what they are going through, so a little bit of a routine back into their life can be another step forward.
Maui County officials say 2 fires have not yet been completely contained. Former President Donald Trump could be, in a matter of days, indicted for a 4th time, this time by a grand jury led by Fulton County District Attorney Fani Willis. It widely is expected that Trump will be charged with attempting to overturn the results of the 2020 presidential election in Georgia. Willis may ask the Georgia jury to consider some charges not used in the previous indictments against him. Former U.S. Attorney Michael Moore says he thinks there will be multiple defendants indicted. Moore also believes Willis could go further with racketeering charges against the former president and his allies.
It really allows her to talk about, as a prosecutor, everybody's dirty laundry and everybody's dirty conduct, and not just the dirty laundry maybe that the former president may have in his hamper.
There has been extra security in Atlanta. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr, and this is Bloomberg.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$11.40 on Wall Street. I'm Amy Morris. Shares of U.S. Steel still on the rise after it rejected a more than $7 billion bid from Cleveland Cliffs. We talked about that rejection with Bloomberg News reporter Joe Dome.
The thrust of what they argue is they haven't had enough time to do due diligence of the deal. And one of the big things that they pull out of that is saying we haven't had a chance to really understand the potential antitrust issues that would be at play here.
Bloomberg News reporter Joe Doe, a guest on Bloomberg Surveillance. Shares of U.S. Steel now 29% higher. Cliff shares up nearly 7%. We check the markets all day long right here on Bloomberg Radio. The Dow is mostly unchanged, only up about 2 points now. S&P 500 up 0.4% or 16 points. NASDAQ up 0.6% or 87 points. The yield on the 10-year Treasury at 4.16%. The 2-year yield at 4.94%. NYMEX crude oil at $82.79 a barrel. That's down 40 cents. Brent crude at $86.40 a barrel, down 41 cents. COMEX gold at $1,942.80 an ounce, down $3.80. The euro at 1.0922 against the dollar. The British pound at 1.2692. The yen at 145.26. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate that. You know, looking at the yields here today, again, we got the yields moving a little bit higher. The 10-year, 4.17%. Who'd have thunk that just recently? And the 2-year pushing back up towards that 5% range, 4.94% on your 2-year. Tim Urbanowitz joins us, head of research for Innovative ETFs. Hey, Tim, over there at Innovator, how are you guys thinking about this market here? I mean, do we have asset allocation discussions to have between equities and fixed income? Because I don't mind parking myself at a 2-year Treasury and getting close to 5%. How are you guys thinking about this?
Yeah, well, a lot of the focus, Paul, is on interest rates right now, whether you be a bond investor or an equity investor. And one of the issues that we've been calling a lot of attention to really over the last 6 months or so is it's not just about the Fed raising interest rates and when they're going to stop, but we also have treasuries that face a very poor supply and demand backdrop. You know, this isn't the post-global financial crisis period where you had the Fed that was out there buying up treasuries at any price. No, you now have a natural bid that's going to be required. We've gone from QE to QT. At the exact same time, we also look at foreign ownership of U.S. Treasuries as a percentage of the total pie. We're at about a 19-year low. You saw the news with Japan, the change they made to the yield curve control policy, just adding more pressure to Treasuries and interest rates across the board. And for us, the conversations that we're having with advisors right now, it's really about how do you decouple, how do you separate your income and your risk management needs from interest rates? Because interest rates continue to face pressure. We think that's becoming much more of an important conversation here now.
Talk to us about your family of ETFs and particularly the buffers, because these have seen some really big flows this year.
They have, yeah. And I think a big reason for that is clients are looking for ways to manage risk beyond the traditional 60-40 allocation. So you look at the traditional buffer ETF, we have a suite of 3 different ones that are made, a 9% buffer, 15% buffer, and a 30% buffer over 12 months on the S&P 500 ETF SPY. The most popular one thus far this year has been the 15% buffer, just given the various outlooks for the market. And what's really so special about these strategies, it really helps remove a lot of the unknowns, a lot of the guesswork that is out there.
So, but explain, Tim, how the buffer works to, say, a retail investor.
Yep. So very simple, over an outcome period. So over 12 months. We know that if the market goes down anywhere from 0 to 15% on a price return basis, we're going to be fully covered or fully buffered against those losses. And then the trade-off for that is you're also getting upside exposure up to a cap. So for a 15% buffer example, you look at PAUG. This is the August series. You're getting upside exposure to the S&P 500 ETF to about the first 15% of gains. And again, you have that 15% downside protection in place over the outcome period, point to point. So really just a good way to put some surety around the risk management.
That's pretty cool, right, Paul?
Yeah, it's called. I kind of do that through the structured product route. I'm probably paying a little bit more than I would do if I just did
Exactly,
the ETF
because
route.
if you look at, for example, let's see,
But I gotta keep my boy Tony in the
equity
Yankee tickets.
description, you can see that they have 0.79% expense ratio.
It's pretty good.
And you're probably paying your guy a lot more than that.
Yeah, but he gets me good Yankees tickets.
Oh. Tim, can you get Paul some good Yankees tickets once in a while?
We can figure out a way to make that happen.
Hey Tim, where are you seeing the interest when you talk to kind of your clients? What do they want to see from the ETF space these days?
Well, one of the ones that we've seen a tremendous amount of demand for out of the gates, it didn't even launch a month ago. We got almost $100 million in assets in the strategy already, is TJUL. This is the first ever strategy that provides a 100% downside buffer over a 2-year outcome period, with upside exposure to the S&P 500 ETF to a cap of about 16.6%. So really the demand here and why we brought this strategy to market is you look at the equity market, far and away the single greatest creator of wealth on the planet. Yet at the same time, individuals simply just don't hold enough of it, or they're too scared to even get in for fear of those intra-period drawdowns, the volatility. So this was really a strategy that we brought to help clients really reduce those cash allocations, tie more of those low-risk dollars to the equity market as opposed to bonds or cash. And over time, we think it's a good way to really help outperform, given that you're tied to equities as opposed to fixed income or cash.
So you completely shield investors from any losses on the S&P, and in return, you give them an upside exposure up to, I guess, 16.x%.
That's exactly right. And, some look at that and say, well, it's only 16.6%. Yes, but we're not thinking about this as an equity replacement, right? We're comparing this.
Well, it's a 12-month period, right?
This one is 24 months. So this is 16.6% over 24 months. So a little bit longer, but still giving you a much higher return potential even than we see in short-term bonds or cash right now. And if you look to it, especially high net worth individuals keep a tremendous amount of their assets in cash. Right now, it's sitting at about 34%.
Really?
That creates a tremendous drag on portfolio returns over the long haul. So really, we're encouraging advisors to think about this strategy think about it as that secondary liquidity bucket, the cash you don't need in the next 6 to 12 months. How do we take that excess cash, tie it to the equity market, and help reduce a lot of that potential cash drag over an extended period of time?
I mean, are some of the clients? I mean, you look at the S&P; it's up close to 20%. The Nasdaq up, 30% plus. Are you finding people want to get more conservative of where they kind of put their money these days, or are they still saying, "Hey, I've got a Fed that's at or near peak rates. I've got an economy that's probably looking at a soft landing. It's all lights say go."
It's still a lot of that hesitation, and one of the things that we've been looking at that's very interesting. We've shifted from this mindset where the recession was the consensus to now, as we're nearing and approaching the end of that hike cycle, the soft landing is consensus. And what's so interesting about that is if you look at the last 6 recessions, ex-COVID, at the end of the hike cycle, as that hike cycle came to an end, the soft landing became consensus in each of those 6 instances as well. So we really don't know what type of damage is really going to be felt in the economy overall. So we still have clients that are hesitant. They want exposure. And if you look back historically, the pause and when the hike cycle ends is a very profitable time for equities. So we don't want to be out. But that also doesn't mean that these recession risks are just going away because they haven't materialized thus far.
All right, Tim, thanks so much for joining us. Always appreciate getting a few minutes of your time. Tim Urbanowitz, Head of Research at Innovator ETFs. ETFs, you just can't stop the tsunami of money going to ETFs, can you?
No, and it's very important to watch ETF IQ every Monday on Bloomberg Television at 1 p.m. with Matt Miller, Katie Greifeld, and Eric Balchunas.
That means you should probably get out of here around 12:30 so you have time to prepare for that. Okay, I see how that works.
I'm going to put on a suit.
Yep. All right.
Brush my beard.
Eric, make that a note and time card for Matt here on the Bloomberg Markets here. We'll dock him for another half hour's worth of work. But good stuff there on Bloomberg Television. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. United States Steel has rejected a $7.25 billion bid from rival Cleveland Cliffs and will begin a review of its options instead. Bloomberg's Kriti Gupta reports.
U.S. Steel announced a formal process to assess its alternatives after receiving approaches for parts or all of the business on Sunday, with Cliffs going public with its offer just hours later. Now, Cliffs did say it submitted the proposal privately on July 28th and received a rejection letter calling the offer, quote, unreasonable.
Now, shares of U.S. Steel right now up about 30%. Shares of Cleveland Cliffs up about 8%. Flights between the U.S. and China are set to double from 12 a week to 24 by the end of October as the countries relax travel restrictions. Bloomberg's Danny Lee says there's still a ways to go.
These frequencies, a doubling is a boost for many. However, you have to put it in context of what it was before the pandemic. It was 340 per week in each direction. And so we're still at only 7 or 8% of pre-pandemic capacity. So this is still really way down on where we are.
Now, PayPal has named a new CEO. CNBC says Alex Chriss will take over the role starting on September 27th. Now, Dan Schulman will remain as director. Shares of PayPal right now, well, they are up about 2%. And NWTN will invest $500 million in China Evergrande, new energy vehicle group. Under the deal, NWTN will buy nearly 28% of the troubled vehicle maker's ordinary shares and majority of its board. Now, shares of NWTN up about 6%. Shares of China Evergrande up about 14%. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Brokers studio. We are also going the YouTube route as well, so you can check out the live stream video there. Just go over to YouTube and search Bloomberg Global News. S&P 500 up 0.5%, NASDAQ up 0.75%, and some good movements there. WTI crude oil off just a little bit here, still about $82.50 on WTI crude oil. Looking at the VIX for Tom Keene, it is below 15, 14.88 on your VIX. With our news in New York City, here's Michael Barr.
Paul, Matt, thank you very much. 11:56 now on Wall Street. Officials on Maui now say at least 96 people are dead from wildfires. Hawaii Governor Josh Green, who is also a doctor, gave a grim assessment on CBS Mornings.
There will not be any survivors in the area left. They've either escaped and escaped that night. And now, as we put up some temporary cell capacity, people are calling each other. So the number of missing went from in the 2000s down to 1,300.
Officials are warning residents that it remains too early to return to some parts of the island where firefighters have extinguished flames. The fire melted metals and plastics from cars, homes, and gas stations, leaving behind a stench of noxious fumes. Tighter security outside the Fulton County, Georgia courthouse as a potential fourth indictment closes in on former President Donald Trump. District Attorney Fani Willis is reportedly presenting her case to the grand jury today. Willis probed in the spark and part of that of a phone call from Trump to Georgia secretaries of state after the 2020 presidential election. The Marion, Kansas Police Department being slammed for raiding a small local newspaper office and the home of its owner and publisher. Eric Meyer says the stress caused the weekend death of his 98-year-old mother, who co-owned the paper. Myers says the search warrant tied to the raid involves a dispute between the Marion County Record and the owner of a local restaurant.
If they think I'm going to give up because they've made it difficult for us to put out a newspaper for 1 week, they've got another thing coming.
Press freedom organizations are condemning Friday's raid. New Zealand has ended all of its remaining COVID-19 restrictions. Prime Minister Chris Hipkins says reported cases are at their lowest level in 18 months.
The formal end of what was a uniquely challenging time for the country and, of course, for the world.
Hipkins says it's hoped that this was his final media conference about COVID. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt.
All right, Michael Barr, thank you so much. We appreciate it. So, Matt, Sam Bankman-Fried was on, I guess he was on parole, or he was just...
He's on bail.
Bail, and at his parents' house arrest, probably with the monitor around the ankle and all that kind of stuff. But that changed on Friday. He's now in Brooklyn Detention Center. That's not good.
Yeah, no, I mean, for him, that's not good. But the problem is his bail was revoked by the judge, Lewis Kaplan, at a hearing here in Manhattan on Friday. He had, I guess, pushed the limit a little bit too often in terms of talking to other witnesses. And the judge was worried about potential tampering there. In fact, there was a great quote from Lewis Kaplan on the bench that I thought could apply to other cases as well. The judge said, a defendant's speech is not protected to the extent that it is intended to bring about a crime.
Right.
So, you could, I guess, read that as you like, but I think it could be applied to a number of cases today.
Metropolitan Detention Center in Brooklyn, or MDC, is the main federal prison in New York for defendants waiting trial. It's unclear how long Bankman-Fried will stay at the MDC, with prosecutors suggesting
he's trying to move upstate, right?
Yeah, he could potentially be moved to Putnam County Correctional Facility in upstate New York. But any way you slice it, Sam Bankman-Fried in a federal jail in Brooklyn, that's not probably what he was looking for here in the interim. But again, if you potentially try to tamper with witnesses, that's potentially what you get there. So we'll keep up on that story. That is front and center in the world of crypto. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, busy. We're going to start off with a look in Hawaii. We're going to look at it from the perspective of insurance. What could the insurance losses be here as the insurance industry starts to take a look there? Matt Palazzolo, he's a senior insurance analyst for Bloomberg Intelligence. He'll join us on that. Plus, Clara Ballantyne, personal finance reporter with Bloomberg News, joins to discuss her big take story, simply entitled, Are You Rich? And there's a lot of good reporting in there. And then for Matt, we're going to talk to the former Tesla chief investment officer. He's now the founder and CEO of Tekion, which is a tech company that provides car dealerships with software to simplify buying. And we'll kind of figure out how that all plays into the ecosystem of electric vehicles. But right now, let's get some news here from Denise Pellegrini.
Hey there, guys. It is 12:01 on Wall Street. We do check the markets for you, of course, all day long here at Bloomberg. Stocks are higher now, but barely. There is some concern about the Fed, about interest rates, and about the continuing balance sheet runoff, right? That's another form of tightening. And Drew Mattis, chief market strategist at MetLife, says, well, he's worried about all the, what he calls imbalances in the economy.
Well, in the United States, if you look at goods prices, we're in deflation now for that. And the question is, how pushy will service inflation be over the next couple of months? And how long is that going to hold up overall inflation in the United States?
Yeah, Mattis with us there on the Bloomberg Surveillance podcast. Right now, the Dow is up, but just barely up 17 points. The S&P 500 doing a little better, 0.4% higher, 18 points. The NASDAQ, winner of the day, up almost 0.7%, about 93 points. The yield on the 10-year right now, 4.167%. We did see 4.2% earlier, so haven't seen that in a while. We're on watch about that. NYMEX crude, it is lower right now, down about 0.7%, 86.22 a barrel, we'll call it. Spot gold, it's also lower, down about 0.1%, 19.11 an ounce. PayPal up about 2%. It's naming Alex Chriss, chief executive officer. He used to lead Intuit's QuickBooks. And shares of U.S. Steel up about 30%. After it rejected that takeover offer from rival Cleveland-Cliffs. Now, Cleveland-Cliffs trying to create one of the world's biggest steel makers. U.S. Steel says it received multiple offers. It says it's undertaking a review of its strategic options. All I can say, guys, something for investors to remember when they see a beaten down stock. It's just the value at a given point in time. Because you remember, it wasn't too long ago when U.S. Steel, when we were all talking about its possible impending bankruptcy about 6 years ago. Now, I mean, the stock is up about 30% right now. I mean, nothing like a little mini mill to sort of get your stock going there.
All right, very good. Denise Pellegrini, thank you so much. We appreciate it. It's fun talking about steel stocks. You don't do that every day, so we appreciate that from Denise. So looking at this market here, S&P 500, kind of close to its intraday high. But let's see what's happening under the hood, get some stock-specific stories. We do that with Alexandra Semenova, covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at today?
Happy Monday, guys. So stock that I'm watching today is Tesla. Shares are down more than 2%. We've, of course, seen some skittishness in tech stocks broadly, but that's not what is driving the move lower today. They rolled out a new round of price cuts in China that's stoking worries among investors that the move could start a price war that was finally showing signs of abating. Tesla marked down the long-range and performance versions of its Model Y car in China, also extending an insurance subsidy for the base version of its Model 3. Evercore ISI analyst Chris McNally, in a note today, said that's likely to result in similar price cuts in Europe and the U.S. soon, which in turn, of course, is going to pressure the company's third-quarter profit margins. You guys remember about a month ago when Tesla reported earnings, profitability was a big concern among investors. Their margins slipped, specifically due to these price cuts that Tesla has been implementing.
All right. I mean, it's just price war, right?
Yeah, I mean,
I don't know, skirmish.
There was a price war. It had sort of calmed down, and maybe this kicks it up again. I think that's
Ford
the concern.
News? I mean, Ford initially forecast a $3 billion loss in EVs. Then they took it up not a little bit
to $4.5 billion.
$4.5
yeah.
billion. I mean,
So what Alex is talking about is in China, right?
Yep.
In the U.S., of course, we saw some Tesla price cuts as well, which led to Ford price cuts. At least that's what Ford said. They were reacting to price cuts over Tesla. But remember that Ford had also raised prices by quite a lot, as had Tesla. So, you're still not getting your truck any cheaper, your F-150 Lightning any cheaper than you would have a couple of years ago.
Yeah, the list price on mine was 94 large.
94?
That I test drove 94,000 US.
And did you feel like it was worth it?
I was sticker shock. I could not believe it that was a number associated with a pickup truck.
Yeah.
Not that I know anything about pickup trucks, and I'm darn proud about that as well. Elena, what else are you looking at? All right, Manchester United. What's going on?
This is something like surveillance already talks about soccer way too much.
Right.
But we're going to just carry that forward?
Yes, we are.
Because it's listed in the U.S.
I know.
How weird is that?
I will tell you guys about the share move today, but you have to promise not to ask me any follow-up questions about soccer as long as we have a deal there.
Not going to happen, yeah.
Speaking of deals, shares are up more than 5% amid ongoing speculation that they will finally close a deal to sell the club. The Glazer family, which of course owns Manchester United, is reportedly set to announce the sale to Qatari Sheikh Jassim bin Hamad Al Thani in a more than $9 billion deal. That's according to reports from the BBC. This has been a long, winding battle for control. Al Thani is, of course, Crown Prince of Qatar. He's the chairman of the largest bank in Qatar, also formerly served on the board of Credit Suisse, and he's apparently a lifelong Manchester United fan. So this is definitely a stock to watch as the deal edges closer to a close.
I mean, so Ratcliffe's not going to get it.
I don't know.
Apparently not, but this has been going on for months now, so we don't quite know until we finally see it.
I mean, it's got a market cap now just under $4 billion. So, I mean, and this, I would guess, I'm not a big soccer dude, but it's got to be one of the top 2 or 3 clubs, if not. I mean, for a long time, it felt like it was number 1 globally. And you got to
you've got
global brands.
Remember, you've got Madrid, Barca.
Yep.
There's probably an Italian team that everybody loves.
We'll throw in a German one just for your.
Well, I mean, Bayern Munich is the most they're like the Yankees of German soccer. Okay. Right. But you know what? I'm bummed that Jim Ratcliffe misses out on this.
Why?
So he runs Ineos, which is like a chemicals company that is kind of maybe boring.
Right.
But he also came out with a new version of the old Land Rover Defender.
Oh. That's a good look.
Because when Land Rover retired that vehicle, he thought, you know what, this is too good to go away. So he bought, I guess, the copyright to the design and made a new one.
Right. You know what's really selling well again? Talking about bringing an old vehicle back at the Bronco. You see them everywhere now.
Ah, amazing.
Everywhere.
Really love. I mean, the design is, I think, fantastic.
Yeah. So Ford did good there. All right, Alexander, thanks so much for joining us. Alexander Semenova, Bloomberg Markets, joining us here. Also joining us here in our Bloomberg Interactive Broker studio, Matthew Palazzola. He's a senior insurance analyst with Bloomberg Intelligence.
Whenever I see this guy, I know that a disaster has happened.
It is exactly. Bad things have happened. So we call on Matthew Palazzola. So Matthew, we've seen the destruction in Bermuda, the loss of life. It's just horrific, some of the images that we saw. From the insurance perspective, what are you hearing from the companies as to perhaps exposure and all that type of thing?
Right. So nothing yet from the company specifically, but we're looking at industry data from the ground. In these cases, you'll hear about economic losses first. So we're hearing numbers like 5, 6. I just saw one for $8 billion of economic damages.
What's that, actually?
So that could be lost wages. That could be, it encompasses insured values, but insured values would be much less. So it could be even half of that. So the work that I'm doing now is kind of coming around low single-digit billions for the insurance companies, which is a pretty manageable number.
Right.
So, but the thing is, these payouts are probably going to get bigger and bigger every year, right? Not just what's happening in Hawaii, not just, what the El Niños brought, but every year, did natural disaster payouts climb higher and higher?
That has been happening, right?
Yeah.
So it was thought of years ago that $100 billion in insured losses was something we'd never see, and now we've seen it for several years. So this year so far is running above average for catastrophe losses. Climate change is kind of the big boogeyman in the whole thing. No one's saying it's not happening, but the insurance companies will tell you that a lot of this is driven by density of population, building in catastrophe-prone areas. It's kind of moral hazard where we keep building, we keep rebuilding, and the cycle goes on and on. So it's not all climate change. I wrote down the stat I did want to tell you, though. This is according to a catastrophe modeling company. They said, over the past century, Hawaii, the average burning there has increased 400%, due to man-made factors. So obviously something's happening. I also thought this was interesting. There's a non-native grass species that was introduced to Hawaii, which actually is feeding a lot of this because it's fire-prone.
Right. So, I mean, there's all kinds of drivers here. Going to that issue of the moral hazard, I mean, a hurricane comes along, take your place, Florida, North Carolina, South, wherever it hits, wipes out a part of the coast.
The insurance guys pay up, and people build houses right back there again.
Yeah, forget about that. I'll take that to my Jersey Shore. Superstorm Sandy. You go down to Maniloking, which have some of the nicest homes on the Jersey Shore. They have rebuilt monster homes, and then the next lot, for whatever reason, completely blank. Nothing's been rebuilt. So I don't know if there's money's held up with the family or whatever. But is that person who rebuilt the monster house again, is he or she getting insured?
Look, depending on the monstrosity of the house, you might not be insured.
My experience with Chubb is after you take a big hit, they don't come back.
Yeah, so I mean, if you have enough money where you built that house on your own, you don't have a mortgage, you don't have anything, I guess theoretically you could not have insurance. What's happening, though, in these states is a lot of it's falling on the state. So when you can't get insurance in Florida, in California, there's a state fund that you get insurance from. So ultimately, it comes back to the taxpayer. So it's not, the insurance companies have wised up. They don't just keep paying out. They will step back and drop these people. But what happens is...
Or charge higher rates.
They'll definitely charge higher rates. Or they'll charge you such a high rate that you'll go to the state fund.
Does the state fund lose money?
Hand over fist.
I see.
And who funds that?
We do.
Okay.
Yeah.
You guys.
Very good. But that's, again, at some point, my good friends at the Jersey Shore, I'm just picking on them because that's where I crib these days. I mean, I don't feel like they should be insured. I mean, if it's given what's happened, but I guess it's up to the companies, and if maybe they can decline to have insurance, right?
This question may be beyond the scope of Matthew Palazzolo.
No. This is breakdown.
I don't know. We could get the situation in here from Jersey Shore. Maybe you would know. But no, I mean, like I said, if you have a mortgage on your property, you have to have insurance.
Yes.
And
that's the right thing.
The state is not going to let people be completely unhappy and not have insurance and it be too expensive. So that's where this kind of comes in, and people don't realize that the taxpayers are ending up funding this.
It's not the Jersey Shore that takes the big losses, right? It's Florida.
It's Florida.
Yeah, it's Florida and it's California. It's Texas to some degree. I mean, we had Sandy. That was kind of an odd-off event. But, I mean, we also had I don't even remember if it was last year, where we had these significant rain events repeatedly, and it was the most rain ever, and then the next week it was the most rain ever again in, the tri-state area, so it is happening.
All right, so we're August 14th here. What's the hurricane call this year? I mean, so far I don't recall nothing big has hit here, has it?
So it hasn't been. It started off quick and hot, right? And I was pretty worried that it was going to be above average season. So you've got two countervailing forces. You've got the El Nino effect, which you brought up before. That actually suppresses hurricane activity in the Atlantic.
Is that just wind blowing somewhere?
It's a hot current, right?
Essentially. I'm just an amateur meteorologist, so, I'll have to take a step back and say, yes, it's basically just winds moving, right? That usually suppresses hurricane activity here. But then you have these record sea surface temperatures, which feed hurricane activity. So this has netted itself out to be, from the forecasted to be an above average season. But we haven't seen that much yet. The peak is about mid-September.
By the way, El Nino is a warm current of water, or ocean water, that develops in the central and east central equatorial Pacific.
And do you know the opposite?
La
Nina.
La Nina, the girl.
Right.
So
Right.
El Nino is the
other way.
boy, La Nina is the
And
girl.
we've been in La Nina for a while, which has actually fed hurricane activity.
All right, the S&P 500 property and casualty insurance sub-index down 5% this year.
Yes. So insurance companies suffered from, I think, the risk-on environment in the beginning of the year. The defensive stocks, they kind of sell off with that rotation. I think unfairly they suffered with the bank turmoil. They weren't really exposed. Another concern is commercial real estate.
I mean, the concern
exposure.
there is that they hold a lot of long-term, for example, treasuries, and maybe they haven't marked to market either.
So they did that last year. That was a big impact. So they still do. It's kind of reversing this year. They hold a lot of commercial real estate, more specifically maybe the life insurance companies. We did analysis on that. It seemed to be very manageable exposure for them. In a bad case, it hasn't really reared its head, but I think those things were kind of dragging them down.
And otherwise, how are they making returns? Because that's the idea, right? We all put in our premiums, and then they take that money and they go invest it, and hopefully they make more than they lose on these natural disasters.
Exactly. So fundamentals are good. They've been, earning. We're at, it could be peak ROEs for this pricing cycle. Could be this year or next year. Typically, valuations peak before the ROEs. So if it's this year, then maybe they peaked already, but it could be next year.
Are there any hot, what are the best managed insurance companies that you cover?
I love Chubb, right? It's the biggest, and it's still growing a lot. Evan Greenberg's the CEO, of this giant company, and he kind of knows all the ins and out details. They have the best commercial underwriting of their peer group, and they're the biggest one. So I love Chubb's management and strategy.
They won't take me. They won't take me as a client.
They wouldn't take you? Of course.
They did once, but I guess too many losses, too many claims.
Yeah, like a motorcycle? There's no way
The
I'm writing you
motorcycle
any
accident
insurance.
may have been a part of that.
may have been
Did you have your Picasso in the basement when it flooded?
No, I didn't have any really big problems. Just I think there was a small issue with the Porsche 911 and the motorcycle accident.
The motorcycle accident and the jumping out of planes and all that kind of stuff. What's the area of insurance that you just are staying away from it right now in your space?
Staying away from. So what's interesting? Cyber insurance, right? Cyber insurance is a big growing line of business. A lot of companies are getting into it. They've been very cautious on it, but you don't know what you're underwriting, and I think the world is not getting it's not getting any less risky, right? And it's getting more risky, and these are things that companies don't know about. So I'd be a little wary of someone who's talking about growing a lot in cyber insurance right now.
All right, Matt. Good to have you in our Bloomberg Interactive Broker Studio. Matthew Palazzolo, he's the senior analyst covering all the property and casualty insurance for Bloomberg Intelligence. Looking at the markets right here, kind of mixed here on the screen right here. The S&P 500 up 0.3%. The Dow pretty much unchanged, off about 19 points. NASDAQ up 0.6%. We're going to have more coming up as Matt slinks out of the all. This is Bloomberg. Get some company news right now with Lisa Mateo.
Good morning. Tesla has rolled out a fresh round of price cuts in China. Bloomberg's Craig Trudell has more on that pricing pressure.
As input costs come down, we saw the last couple of years, not only the semiconductor crisis putting some pressure on companies, but also raw materials for batteries. So lithium and nickel prices in particular really being a difficult challenge for these companies to work through. Those prices have come back down.
Now, shares of Tesla right now down about 2.5%. Shares of BYD down about 5%. And Nikola is recalling more than 200 of its battery-powered electric commercial trucks and pausing its sales. And this after a defective battery part allegedly caused a fire. Bloomberg's Katie Greifeld has more on the stock's performance.
Today's plunge follows a pretty stellar run for the shares. Actually, if you look at the past 3 months into Friday's close, Nikola shares were higher by about 154%. But zooming out for the context, Nikola is down over 80% from its 2020 IPO.
Now, shares of Nikola right now down about 9%. And PayPal has a new chief. CNBC says Alex Chris will take over as CEO starting on September 27th. Dan Schulman will remain as director. Shares of PayPal right now up about 1.5%. And shares of Hawaiian Electric, they are plunging down right now about 35% over worries that its power lines may be linked to the deadly Maui wildfires, which have killed more than 90 people. Now, Hawaiian Electric, that's being criticized for not turning off power despite those warnings that dry, gusty winds could create fire conditions. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is...
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Well, it is 12:21 on Wall Street, and we do check the markets all day long for you here at Bloomberg. Stocks are mixed right now. Maybe a little bit of a hangover. Worries about the economy, inflation, Fed tightening. The Dow right now down about 17 points. That's just fractionally, though. The S&P 500, it's higher, up about 0.3%. And that's about 13 points. The NASDAQ is up 0.6%, 77 points. The yield on the 10-year right now, it is back down now to 4.15%. Last time I was up on this little podium here behind the pole, it was 4.16%. We had 4.21 earlier, so we're monitoring that closely. Spot gold down just fractionally right now. Brent crude right now, it's down more than 1%, 82.25 a barrel. The record-breaking heat waves throughout the northern hemisphere this summer could push up demand for fuel, according to some, as we crank up the air conditioning. And that, according to Sebastian Boyd, macro view columnist on our MLive column, said could produce a lift for oil and higher break-even inflation rates, but we're not seeing that right now. As I mentioned, crude down by more than 1%. Shares of U.S. Steel, though, they are up 31%. The iconic Pittsburgh steelmaker rejecting that takeover offer from rival Cleveland-Cliffs. U.S. Steel says it has received multiple offers for all or part of itself and says it's undertaking a review of its strategic options instead. We're going to talk more about who some of those people interested in the company might be in a little bit. Tesla shares are down about 2%. Tesla cutting prices again in China, triggering concern the move will rekindle an international price war that until now had pretty much shown signs of abating. And that, guys, is your Bloomberg Business Flash.
All right, Denise, thank you so much. We appreciate that. Denise Pellegrini with that update. As you know, Matt and I are huge fans of the big take stories. These are the really in-depth, deeply reported stories that our good folks at Bloomberg News put out seemingly on a daily basis. They do deep dives.
It is on a daily basis.
Is it?
Yeah,
okay.
every day.
I mean, it's just incredible that they're every day. And that's just great for us because we got good stuff to talk about. And this one I really like because it's very simple. It asks a simple question. Are you rich? Claire Ballantyne, she's a personal finance reporter at Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studios. So Claire, what does it mean to be rich in America these days?
Yeah, there's a lot of different measures for it. You can look at income, you can look at net worth. For this story, what we did was look at tax filers that made over $175,000 a year. That's puts you roughly in the top 10%. And then from there...
Even in New York?
Well, overall, across the whole country.
Oh, okay.
So it's the average. But yeah, and then we looked within that to survey some of them and figure out, how they feel about how much money they have.
So some of the people in the survey, I feel like, are sandbagging a little bit, because even some of the people that were making more than $5 million annually were claiming to be poor or just getting by.
It's pretty striking. Yeah, I mean,
You got to call BS on that, right?
How do you feel like that way if you have so much money? That's sort of the question at the heart of all of this. How can you possibly make so much but feel like you have so little? And I think we found a couple different reasons why. I mean, one definitely has to do with inflation. Things are more expensive than they used to be. And the other has to do a lot with comparison. We hear about all these billionaires with private jets. You look at that and you think, oh, no, I'm not that rich.
But there aren't that many billionaires. I mean, I think a lot of this is that some people making more than $5 million a year have just detached their brains from reality. I mean, they're just full of, basically, because let's get real for a second. If you're making more than $5 million a year, you're going to be okay.
Yeah, and I mean, that's what I think so too. But that's what I found really interesting about all of this is just people still worry about money. I think that was a big through line to all of this is that there is this worry, will I have enough? What if X happens? Will I be able to retire when I want to? It's a constant worry and anxiety about money that all these people had.
I get that.
Home ownership, I mean, for a lot of Americans, that's a huge part of their net worth. How does that factor into it?
That was a huge part of it. The people that really felt rich were the ones that had homes that they owned, they had good retirement accounts, and they had a good income. So, it's one thing to be making a lot of money each year, but if you don't own your home, if you don't have these actual assets, it is hard to feel actually rich, I think.
Right. I'm one of the people who said she felt rich in the story, and I think more people said they didn't feel rich. She was already retired, and so was her husband. They were just getting Social Security, but they had other income from investments, I imagine. They had retirement accounts that were fully stocked up, and they owned the home that they lived in.
Yeah, they owned the home outright, which is huge. And also they had put 5 kids, through college or raised them into adulthood. And I think some of the people I talked to that hadn't done that or had that on the horizon, say you have multiple kids and you're thinking about college tuition, that's a huge expense.
Well, how about you're a recent grad from Duke University.
Wow.
Hello.
How did you get in?
She's the editor-in-chief at the Duke Chronicle, which is the daily paper at Duke. That's huge.
Editor-in-chief that is.
All right, but the younger people in this country, they have this student debt thing that is just so much more than my generation had. I gotta feel like that's gonna be an overhang for those people for a long time.
Absolutely, and I'd love to do the story again in 10 years or even in 20 years and see when those people are the majority of the workforce and they have the student debt. That definitely will impact feelings of wealth if you're so in debt.
So how did you go about reporting this story? I imagine you had on the one hand you had a broader survey which you passed out to many people. Or got many people to fill out. And on the other hand, you spoke with individuals who were willing to be in the story. How did you get a hold of everybody?
Yeah, that was a huge part of it all. And, some of it were people I talked to for different stories in my personal finance career, with student loans or other inflation-related stories. And I said, hey, would you want to participate in this? Some of it was finding people on social media who were talking about this issue and reaching out. And then a portion of it was through the survey. We did have an opt-in feature about, would you be okay if a Bloomberg journalist contacted you and got some sources that way? But I was really surprised how many people were willing to be open and honest about this. They would tell me all their financial info, what they made, their net worth, all of that.
That is surprising.
It is.
Yeah, I wonder if it's changed over time what feeling rich is. Is it different today than it was 40 years ago, 60? Yeah.
I'm sure, because you've got so many things now that you have to have that just it wasn't.
And the other
case
thing
back
was,
then.
and the other thing was, back a generation or two ago, a lot of working Americans had pensions that they'd be contributing to.
True.
So when they retired, they have a pension. Now most employers do not offer a pension, so therefore you have your own 401k that hopefully you've been contributing to. So, I mean, that goes to the savings issue.
Definitely, yeah. The ones who had retirement accounts that were, pretty hefty definitely feel a lot more secure. And the ones that didn't, that contributes to those worries about money.
Plus where you live, right? Because I'm sure,
It's huge. That's why I asked in New York, because if you make $175,000 and you're a year and you're living in Granville, Ohio, my hometown, then you're able to live very comfortably. If you make that and you live in New York, especially if you have a family to take care of, kids, forget about it.
Yeah.
It's just very difficult.
It's hugely different. And we've seen with the pandemic, people thinking more about, where their money could go further. And this idea of, I could relocate to somewhere else and potentially get more for my money. And that's been at the forefront of a lot of people's minds.
And it seemed like a thread in the story as well. A number of the people you spoke to were like, all right, I've had enough of this high tax state, I'm moving to Texas.
Yeah, and even the people that hadn't actually moved were thinking about it or looking into it. There's this huge desire to think about where else you could go and what other kind of life you could have that would, be a cheaper cost of living.
Yeah, I mean, it's just, you think about it, with remote work now and hybrid work, we saw during the pandemic, and many people proved that you can kind of do your job from anywhere. So if you can keep your big market salary compensation and go to a lower cost market, man, that's the best of both worlds. And then Mark Zuckerberg at one point said, okay, you can leave Silicon Valley and go to, Des Moines or, but we're going to adjust your compensation. I don't think that got very far.
That didn't, no, but one thing I noticed in your story, you have a guy who moved, I think, from New York to somewhere in Texas, outside of Austin maybe, and he pointed out that even when he's living there, as he makes more money, he takes more expensive vacations, he goes to more expensive restaurants, and he buys the coveted pair of Jordans that he's always wanted. So, your spending habits rise with your earnings in a lot of cases.
Yeah, absolutely. The more money you make, the more you can spend, the more you want to keep up with a faster lifestyle, and there's no amount that satisfies you.
All right, the big take story written by Claire Ballantyne and Charlie Wells. I also want to flag, because they did some great reporting there, but what was helpful to me as well was the data analysis and graphics. Phil Kuntz, Jeremy Diamond, and Dimitrios podcast. I'll go with that. That was awesome in the story. And the big take stories also often have some great graphics too, which just enhances the reporting that we get from these folks. So Claire, thanks so much for joining us, Bloomberg News, bringing us up to date there on what's happening on folks out there. Do they feel rich or not? But I mean, the market's up 20%, so they feel a lot better than they did at this point last year. For those that are invested.
But again, you had some people who were high up on the earnings spectrum and said they were just getting by.
Yep.
There's some people in the story that she wrote. There were some people who said, "Listen, I know I have enough money saved up. I've got enough income coming in. We have the house all paid off, but I just worry about money. It's something that I worry about.
Right.
I mean, more money." Yeah, no problems.
That's right. All right, we'll see what's happening there. S&P 500 up 0.3%. Right now, let's get world and national news with Nancy Lyons.
Thanks, Paul. This is the week that Fulton County District Attorney Fonnie Willis is expected to present her election case against former President Trump before a grand jury. BTIG Director of Policy Research Isaac Boltanski tells Bloomberg this case is unique.
It will be their state-level RICO statute, and so that would allow the Fulton County DA to pursue charges relating to the former president supposedly pressuring state officials to falsify or overturn the election results at the state level.
And BTIG's Boltanski says if convicted of state charges, a pardon would not be available to Trump. Boltanski also says Georgia is more likely to allow cameras in the courtroom. President Biden plans to keep talking up Bidenomics on the campaign trail. He's leading a multi-state blitz this week to mark the one-year anniversary of the Inflation Reduction Act. He'll be touting the success of the measure. Bloomberg government Zach Cohen in Washington says it's unclear if the electorate will buy Biden's pitch.
The question obviously remains whether the American people are sort of understanding that inflation is down
that jobs are still in a pretty good place, and whether they agree that Democrats should get credit for those policy. I think the jury's out on that front.
Bloomberg government Zach Cohen. The death toll is nearing 100 in Maui, where out-of-control wildfires wiped out the town of Lahaina last week. Oprah Winfrey has a home on the island. She's been volunteering at an evacuation center nearby.
You would see people lined up, cots right next to each other. You would see people with all of their worldly possessions in, like a small garbage bag.
Officials are predicting they could find 10 to 20 bodies every day for the next several days. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:40 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks right now, they are mixed. The Dow a little bit lower, down fractionally 26 points. The S&P 500 up about 0.3%. That's about 12 points. The NASDAQ up about 0.5%. Off session highs, but still up 74 points. The yield on the 10-year right now creeping a little bit lower from the highs we saw earlier today. We saw 4.21. Now it's 4.14. We'll call it 4.15%. COMEX gold, it is lower right now slightly, and crude oil down by more than 1%, 82.35 a barrel. Shares of U.S. Steel, though, they are surging up 31%. Pittsburgh-based steelmaker rejecting that takeover offer from rival Cleveland-Cliffs, saying it's undertaking a review of its options instead. Cleveland-Cliffs trying to create one of the world's biggest steel makers, and Richard Bork, senior analyst at Bloomberg Intelligence, calls it a modernization play by Cleveland-Cliffs.
Cleveland-Cliffs probably is 93% blast furnaces today, 7% EAFs, the new technology. This would take them to 80-20.
Okay,
Beyond that, you say, well, gee, that seems not that big of a deal, but it gives them a lot of flexibility, because one of the other things about EAFs is you can shut them off, turn them up, and turn them down a lot easier than you can with blast furnaces.
So a lot of reason, according to Richard Burke at Bloomberg Intelligence, why Cleveland-Cliffs would want U.S. Steel. Says it has received multiple offers. We don't know who else has made offers, right? But I was thinking there was one company that might really want part of it. The ticker is X, right? And there could be someone, guys, who would want that X for their Twitter enterprise. So maybe there's some metal that can go into SpaceX vehicles as well. So Elon Musk, if you're listening to Bloomberg Markets today with Paul Sweeney, Matt Miller, produced by Eric Mull, call us or tweet, X at us. Let us know if you're thinking about making an offer for U.S. Steel. And that, guys, is your Bloomberg Business Flash.
All right, I see what you did there, Denise. Thank you very much. We appreciate it, Denise Pellegrini with that Bloomberg Business Flash. You know, Matt always bails out on us Mondays at this time because he has to go prepare for his TV show, but tough for him. He's missing a very cool EV kind of discussion coming up. Jay Vijayam, he is the founder and CEO of Techion, and he was the former chief information officer at Tesla. So let's talk a little bit what's happening in the EV space. Jay, thanks so much for joining us here. First, let's just start off real quick. Tell us what you guys are doing at Techion.
Hi, Paul. Thanks for having me here. We're looking forward to our conversation. At Techion, as you know, the automotive industry is going through some major trends. Everything from EV to autonomous vehicles, from selling models. Techion is right in the center. So we've created a platform to bring together the major stakeholders in one seamless and technology platform. Manufacturers, the retailers, the ecosystem players, be it software or be it functional industry players like insurance providers, lenders, and others. And then, of course, the beneficiary is the consumer. So end of the day, the consumer really needs to get what they're looking for in terms of their automotive buying experience. We are delivering that through the technology as an operating platform for retailers, manufacturers, and then the participants are the industry software ecosystem players.
So give us a sense, Jay. Tesla has obviously a different distribution model, does not rely on dealerships, kind of goes direct to consumer. How do you think the original OEMs, the Fords, the GMs of the world, the Volkswagens of the world, how do you think they should make this evolution to selling these electric vehicles?
Great question. I don't know if I should say it's $1 trillion question, right? So the way we see it, we are deep into the industry. Techion works with many of the retailers. In fact, the world's largest automotive retailer runs on Techion, and we work with multiple manufacturers as well. So the bottom line is, as you know, trends go through different phases, and they go through a big hype phase where everything is like, for example, I can give you a simple example. Before COVID, everyone said the car ownership is going away. And after COVID, we all realized it hasn't gone away. People are still buying cars. Now, the other trend is people are thinking about everything will go online. People will buy cars online 100%. I don't ever see that happening for the same reason why, Tesla is still opening retail stores, Apple is still opening retail stores. What consumers are looking for, again, putting myself in consumer shoes, the way I shop versus the way my 20-year-old daughter shops for cars versus my wife shops for cars would be different. What consumers are looking for is, give me the choice, give me the experience, seamless experience, doesn't matter how I choose to shop. If I, want to do it online, majority of the, tasks which I don't like, which is signing documents or negotiating price, but there are specific tasks I want to do it in person, like experiencing the product itself, test driving. Like I walk into an Apple store and touch and feel my iPhone or a Mac. I think that is the fundamental. So what I see the industry evolving is the retail model not going away, but the business will evolve to provide the seamless experience for consumers, be it they start at a manufacturer website or they start shopping at a retailer website. Today, the experience is disconnected. That's exactly what we are solving from Techion perspective. Why not use that as an advantage? Because consumers need to go into a retail location to shop.
So Jay,
or whatever. Yeah. Please.
What are you finding from some of these existing OEMs? Do they have that mindset to be flexible about using technology, maybe in ways they haven't done it before? Number one, are they flexible? Number two, are they willing to make whatever investment is required?
Yeah, you see a full spectrum. Some of them are quite flexible, want to do it, and didn't have a very clear path to do it. And I think, fortunately, Techion is helping because, as you know, we are a new generation company, started in 2016. So most modern tech platform, from a cloud native versus also using machine learning and AI, inherently part of the platform. So it was not an afterthought where we went ahead and built something like that. So now we are helping that. And you see there are other spectrum where not a lot of flexibility is there. There is willingness from the senior management at the working level. There is not enough incentive or push to go change. So we see a full spectrum of automotive manufacturers willing to change. Again, we all know the answer is anyone who's truly changing will continue to be in the middle or be in the front in some cases. And anyone who's not changing will be left behind over a period of time.
So Jay, just give us a sense of what product or what service that you guys at Techion provide, say, a dealer or the OEM dealer relationship that's proving, I guess, the most popular at the moment.
Absolutely. There are, we have three offerings. Retail cloud, all interconnected. Retail cloud is for retailers, runs the entire retail operations of a retailer. Everything, if you look at from selling cars online, shopping experience, selling cars online, customer engagement, selling cars in store, and the complete back office, if you would call it as a ERP, like general ledger, AP, AR, running their entire business and payments, because it needs to come together to give the best experience. So that's automotive retail cloud, seamlessly connected to the manufacturer's backend system. So to track vehicle inventory, to order parts and receive it seamlessly, have visibility. And then we have enterprise cloud, which is focused as an e-commerce engine for manufacturers, but having a seamless connection to its dealers. So we have some of the largest manufacturers in the world using Techion. Like, for example, General Motors is our customer. So we have a white labeled platform for them to sell their EVs, but seamlessly really connecting to their dealers as well. So that's retail cloud. The last one is we need to bring the ecosystem together. Partner cloud, where we have technology APIs, and you have insurance providers, lenders. So if you sell a car, you need to sell an insurance. So how do you make that process simple and easy? So how do you bring the providers through technology, seamlessly exchanging data and securely doing it?
All right, fascinating stuff. I mean, it's an industry that is evolving with the times and with the technology, and you got to think about the whole stack there. Jay Vijayan is the founder and CEO of Techion, joining us here to talk to us about EVs and how you kind of bring it all together from the OEM manufacturer right down through the dealer and to the consumer. So the question for a lot of dealers is, am I going to participate in this evolution to EVs, or will I be frozen out like Tesla has done with their direct-to-consumer model? Remains to be seen, but Techion has a view. This is Bloomberg. All right, let's get some company news right now with Lisa Mateo.
You got it. AMC has won court approval of a stock conversion plan, clearing the way for its recapitalization efforts as it faces possible bankruptcy. As shares are down the most in well over 2 years, Bloomberg's Simone Foxman has more.
This stock conversion plan, they want to increase the number of shares. It contemplates also, it says that the company will also convert those private equity units into common shares as of later this month. The whole idea is to shore up capital reserves, pay down debt, and invest in growth plans.
Now, shares of AMC right now down about 33%. And forget about leaving the airport gate to grab a bite to eat. Now the food can come right to you. Thanks to OTG management, Bloomberg's Sarah Rappaport has more about this new service at the nation's airports.
Those famous iPads that you see dotted throughout airports where you can put in your orders from OTG management, those are being retired. They're making you order off your phone now. But the cool thing is, you can get gate-side deliveries, and you can have something like artichoke pizza or Bubby's at LaGuardia get delivered to your seat now at the gate. And it's through the same software that you'd use for like a DoorDash or Grubhub, but it's not an app. It's just a mobile online service.
Now, OTG management will also keep 1 or 2 of those iPads behind the counter for people who have a little trouble using the mobile order service or if their phone died. And PayPal, well, it's named a new CEO. CNBC cites members of the board selection committee who say Alex Chriss is going to take over the role starting on September 27th. Now, Dan Schulman, he will remain on as director. And checking in with shares of PayPal right now, they are up about 2%. Those are the company stories making news. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here, live in the Bloomberg Interactive Brokers studio, looking at these markets right here, red and green on the screen. The S&P 500 up about 0.3%. The Dow Jones Industrial is pretty much unchanged on the moment. The NASDAQ up 0.6. Looking at the yield space, 10-year Treasury absolutely flat here, 4.15% on the yield there. I'll call out the 2-year at 4.93. So, yes, still inverted as it's been for some time, but less so than in recent times. So we keep that in mind. Looking over the commodity space, WTI crude oil, it is off about 1%, $82.37 for a barrel of WTI crude oil. Bitcoin, that's up 0.8%, 29,600, we'll call it. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us. Oh, Nancy Lyons.
That's okay, Paul. Hawaii's Governor Josh Green, who's also a doctor, has been making rounds at a hospital on Maui to visit with those impacted by the massive wildfire on the island. He spoke with CBS News about the ongoing search in the town of Lahaina, not for survivors, but for the remains of those who perished.
We are prepared for many tragic stories. They will find 10 to 20 people per day probably until they finish.
Governor Green says this is the largest natural disasters they've ever experienced. An investigation is underway into the response and the possible causes. Some are homing in on Hawaii Electric's equipment as a possible source of ignition. President Biden is leading an administration-wide effort to mark the first anniversary of the Inflation Reduction Act. We get more on that from Bloomberg's Amy Morris.
The president will travel to Wisconsin tomorrow and host an event at the White House on Wednesday. Treasury Secretary Janet Yellen, Vice President Kamala Harris, Acting Labor Secretary Julie Su, Transportation Secretary Pete Buttigieg, Small Business Administrator Isabel Guzman, and Senior Advisor Mitch Landrieu will all take part in the 10-state blitz. Democrats are counting on the landmark climate and drug pricing bill to fuel the president's re-election bid. In Washington, I'm Amy Morris, Bloomberg Radio.
Former President Trump is denying interfering in the 2020 election in Georgia, with a fourth indictment possibly coming this week. Trump, in a post on Truth Social, says he, quote, did not tamper with the election. He called Fulton County District Attorney Fani Willis phony. Willis is investigating Trump's alleged attempts to pressure Georgia officials to overturn his election loss in the state. Willis is set to present the case to a grand jury all this week. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Matt.
All right, Nancy, thank you so much. We appreciate it. I've always been a big fan of San Francisco. I think it's one of my favorite cities in the country. I've always recommended it to my buddies, particularly the ones coming in from international. Where should they go? But, of course, San Francisco's really been hit hard by the pandemic. And there's another story in the Bloomberg Terminal kind of going to that issue. Headline, tax cut demands are exacerbating San Francisco's property woes. Owners of San Francisco's office towers, shopping centers, hotels, and homes are flooding the county with appeals to slash their property assessments and tax payments as real estate prices sink in the beleaguered city. Some of the world's biggest landlords, including Brookfield Corporation and Blackstone, have filed for assessment cuts. The volume of such appeals has doubled in the 3 years since the pandemic. Assessments for this fiscal year went out in early July, and new appeals are expected to surge before a September 15th deadline to request reductions. It's like drinking from a fire hose, said Mark Ong, founder of Independent Tax Representative, whose firm filed appeals on about $11 billion of San Francisco property for the last tax year. I've done this 37 years, and I've never had a year like this one. So the volume of appeals shows the broader impact of the real estate downturn in cities such as San Francisco, where office workers, shoppers, and tourists have been particularly slow to return after the pandemic. Reduced assessments can lower tax revenue for the city's services, from police to homeless aid, and a recognition by assessors that property values have plunged only adds fuel to the potential doom loop of disinvestment. So tough times for a lot of big cities post-pandemic, most notably it seems like San Francisco. So it's a great world-class city, in my opinion. Hopefully they can bounce back sooner rather than later. Sound On with Joe Matthew. That starts right now.
let's get to the biggest stories in the more than $10 trillion global ETF industry. In just moments, we're going to be speaking with Brian Lake of JP Morgan to discuss their ETFs and how active management can help investors navigate the uncertain environment.
And with fixed income ETFs just booming, we're going to speak to Jerome Schneider of PIMCO on its newly launched ETF Bills, that is BILZ.
And Bitcoin ETF candidates got another dose of disappointment when the SEC delayed its decision Friday, but the next deadline is just weeks away, so we're still focused on those ETFs.
And as always, we're going to talk to Eric Balchunas first at Bloomberg Intelligence. He is with us looking at the flows.
Thank you, Shonali and Matt. The flows in the past week are best described as weak. They were real strong all summer. The past 2 weeks, they've really died down. Yes, SPY is at the top, $3 billion. You like to see it, but look at the 1 month, still -6. The total flows the top, 4.3, that white number, that's low. ETFs typically take in 20-25 billion a week, and you can see their IVV taking in money. And USMV, interesting, that's the minimum volatility ETF from iShares. That had gone away for a couple of years, but I think you're going to find more ETFs like that on the leaderboard as people look for equity exposure, but without the sort of overweight to mega caps. Let's look at the outflows, and you can see why that number for the total is so low. It's because of the Qs. 4.2 billion out of the Qs, that is a ton. Remember, the Qs they've been rallying all year. It's up 37%, and the market's getting a little tired, and I think it's going to look for things to spook it, and the trading crowd is going to really leave quickly, as you see here. And so you look down here, EM also, and small caps IWM. So with that, let's look at the flows into domestic and international equity ETFs for the past several months, right? So remember, they were pretty weak early in the year because people like the yields in money market funds and bonds, but then they started having really big returns, and people were like, oh, let me go over the equity market. And this summer, look at how thick the flows were into domestic equity and international. But look at August. Nothing, right? Nothing. It's netted out to zero, right? So a complete collapse. So the performance is shaky, Shonali, Matt, and the flows are now following it.
Yeah, ETF investors seem a little bit late to the party this year, no matter where you look. Eric, let's talk about that right now with Brian Lake, Global Head of ETF Solutions over at JP Morgan. Brian, thanks for coming in. Glad to have you in the studio. What do you think of the flows?
Yeah, no, Matt, I think when we look at what's happened in equity markets, as Eric just talked about, you know, they surprised everybody. They caught a lot of people off sides. Coming off of a tough 2022, you didn't expect the NASDAQ to rally by 36% the way that Eric just pointed out. You know, what I think is interesting is how the flows have been continuing to trend towards active. In fact, the last 2 weeks, we've seen active outflow passive in the ETF space. And I think that's particularly interesting on the fixed income side, which I know we're talking about a little bit as well today. I think of active and passive like I think of a black and white TV and a color TV. There is so much more that a color TV gives you with that picture, and that's like active fixed income in my mind.
I'm very curious about what people want, because if you look at, for example, the NASDAQ Equity Premium ETF, it is so heavily loaded. You're getting essentially NASDAQ plus extra big five, if you will. So what are the people asking for when they're looking at exposure, especially in big tech, where interest has certainly been coming back?
Yeah, big tech has led this rally, but I think what we're going to see is an interesting kind of next couple of months going forward. And I don't think about the macro as much as I think about the individual investor. What do I do with my money now? And that's why I think JEPQ, JEPIC is a really interesting play right now. It keeps you in equities, but it gives you this covered call option overlay where it's still yielding north of 10%. And not a lot of people know this about JEPIC, but it actually incorporates an AI component to the investment process. We all know AI is important, and it's going to be a big part of what we're all doing, but the data set that goes into that is so important. And we have 40 years of history of all of our analysts at JP Morgan, and then we apply generative AI to do that, and it's incorporated as part of the JEPIC story. And I was here last time, and I suggested that we look at JEPIC versus JEPE, and in fact, JEPIC has had more inflows in July for the first time ever than JEPE did.
So let's talk about this. Your color TV, I will say though, yes, but typically the difference is active got cheap. You know, JEPE's a great example, 39 basis points. Bills later is 14. We're going to look at that one. So I think active got cheap and the money started to follow, and I agree. There's a wide spectrum now of interest in ETFs. JEPE, okay, obviously the fastest growing active ETF of all time, beat ARC, took in more flows. But if you look at the flows, you know, they're kind of starting to die down. You're seeing outflows occasionally on certain days. It's underperforming the market. And I guess the question I have is how much more can this thing go? Because you saw some of the returns. What you give up in JEPE is a melt up, and we had a melt up. Yeah, I mean, the flows are pretty good considering that, but talk a little bit about how much more JEPI can go from here.
Yeah, so a covered call strategy is always going to give up some of that upside if you have a straight up market. And that's basically what we've had for the first half of this year. Now, the question I would ask investors is, do you think we're going to have a straight up market from here till the end of the year? Or do you think we could go sideways or potentially is some risk baked into this? And so, you know, if you don't think we're going to have a straight up, then JEPI does still play a really strong part of the portfolio, JEPIC as well. So I think that you can continue to see that grow. Look, JEPI is closing in on about $30 billion in assets. In the grand scheme of things, like all funds, there's still plenty of room. We've seen funds get to be mega funds and then mega funds, right? I mean, how big is SPY at this point?
So do you think, I mean, when Eric showed the chart at the top of the show, and we saw ETF investors getting into stocks in June and July, they're late to the party. Why the disconnect in the ETF world versus, you know, the cash trade?
Well, I think, you know, first of all, you had a really challenging 2022. You had an aggressive Fed that was raising rates at a very rapid pace. And I think that there was a lot of investors that were caught off sides. I mean, don't forget, ETF investors cut the entire spectrum of investors, from individual retail on up to some of the most sophisticated investors. And so when you look at the flows, there's going to be a lot of information coming into that in that way. You know, I think about active fixed income right now. We've got a short core plus strategy managed by Carrie Fitzgerald, who came up with the black and white and color TV thing. Yield to maturity on that is 6.5% with a duration of 3.5 years. So your yield to maturity is kind of what your annualized return you think you might get. Well, we know what the equity risk premium is. It's about 6%, right? And so if I can get that in a safe fixed income portfolio, maybe that's where I should be.
What's the ticker? What's that ETF ticker?
The ticker is JSCP, JP Morgan Short Core Plus. And we think that that's a really interesting thing to look at in this environment.
I want to go back to a point you were making about if you think the market is going sideways or if you think that we have a leg down from here, how much are you seeing investors looking to hedge, and how much demand do you expect that to get over the next 3 to 6 months? There's a lot of kind of uncertain events in the market.
Yeah, hedging is an interesting question because, as we were just kind of talked about, are they hedging, or are they going to look at it as an opportunity to deploy some of the cash that maybe they didn't get a chance to in the first half of the year? And so, you know, that would be the JEPI, that would be the JEPIC kind of trades where you do have that covered call that can protect to the downside. Remember, you know, in 2022, JEPI outperformed the S&P by 16% because it was able to protect to the downside. So if investors are nervous and they want to kind of get some of that income with some of the downside protection, maybe those are the types of strategies they'll look at.
Let's talk international. BBEU, you guys put a ton of money. You rotated into it in your models. It was leading the flows, and then you've pulled some out. And international really was like, had a good run for about a year and a half there. And then the Qs just take over. They got that special something in American innovation, I think, that you don't get overseas. Will we see a reversion back to international now that there's such high returns here? Or do you think, like, I guess in other words, are you going to go back into Europe or international or stay to the U.S.?
Yeah, I can't speak to specifically what we're going to be doing in the models, and certainly we've seen BBEU used to great effect. That's how some of these ETFs are built. You tactically go into it and you take some performance, and then, as you were talking about earlier, maybe you take some gains. We do think the international space is interesting. As you know, we've got the largest active equity strategy that's XEM, so JIRE, J-I-R-E, which is actually a conversion strategy that we brought over. It's $5.5 billion. This is kind of a low tracking error type strategy targeting kind of 1% alpha above and beyond its benchmark. And so I do think that there's a really interesting play there. Maybe we've got a strong dollar and that could soften a little bit, which could also help some of the international equities as well.
So real quick, you guys are the 7th biggest ETF issuer, but you are gunning for number 6, which is First Trust. First Trust has kind of had a flat year, only $3 billion in flows. You guys have taken in $25 billion or $23 billion, but you're $25 billion behind them. Once you pass them, the next step is the Big 5. I bet Athanasios and my team that you would pass them by the end of the year.
This is the wager.
Yes.
In the office.
Am I going to win this bet? It's $25 billion away.
I appreciate the vote of confidence on that one, Eric. You know what we're focused on, and this is obviously how I'm going to answer that question, is serving our clients well. And if we keep doing the things that we're supposed to be doing, fiduciary active management, serving our clients, they will entrust us with our money, and we'll see if that happens.
That's the best you can do.
That's the best I can do. That's all I can control.
Great having you. Double down bets, so it's unfortunate.
Serving our clients. Everybody says that.
Yeah, but you got to do your job well if you want your clients to keep coming back with more more money.
Yeah, our job is help investors meet their financial goals. That's our role in that, and we're focused on that every single day.
Brian Lake of JP Morgan, thanks very much for coming in the studio. Coming up, the SEC still deciding whether or not to approve the ARC21 shares Bitcoin ETF filing. Here's ARC CEO Kathy Wood and what she believes will happen.
I think the SEC, if it's going to approve a Bitcoin ETF, will approve more than one at once. So then, again, because most of these essentially will be the same, and it will come down to market.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to ETF IQ. I'm Shanali Basak, and it's time now for the ETF Brief, where we're going to highlight stories and trends that caught my eye. We're going to talk about the short volatility trade first, because if the VIX looks a little calm to you, it's the calmest since 2019. Underneath the surface, you have a lot of people selling options, going short volatility, and there has been a 60% surge in assets in these types of ETFs this year, according to Global X. So take a look at that and keep an eye on it for the rest of the year if you think things look a little calm out there. I also want to take a look at corporate bonds, because if you take a look here at LQD, the shares outstanding were just booming through 2020 as corporate bonds lifted back after the COVID crisis. However, they have really slumped since then, but they are regaining some shares ever since you saw equity market really start to hit the top here and investors fly back into corporate bonds. Lastly, I want to talk, Matt, about BITO. This is the first Bitcoin futures ETF out to market, and take a look at how it's done since then. If you took a look at the first couple of days, assets surpassed $1 billion, the fastest ever for an ETF, but since then, they had to go through 2022, jumping back this year just in time for the discussion around the first ever, potentially, Bitcoin ETF approved by the SEC, but we haven't seen it yet.
Let's talk about that right now. Shanali Basak. We are going to bring in Bloomberg's Vildana Heinrich to talk about this. She wrote the story about it, the delay, the punt, as it were, from the SEC. So we were expecting a decision, today, right, on a Bitcoin filing, and they've pushed it forward.
We were expecting a decision. It was technically by Sunday,
okay,
so
right.
A lot of people were expecting that we would hear back from the SEC by Friday. I think it was widely expected to be delayed. The SEC has a certain period of time during which it can delay, reject, or approve a filing, and a lot of analysts, including at Bloomberg Intelligence, believed that the SEC would delay because as one of the analysts said to me, why not? If they have the time to delay, then they will.
Which one was this? This was the 21 shares.
The 21 shares, that's right.
But there are so many physically backed Bitcoin ETF filings out there that it's hard to keep track of all of them.
So what happened with the 21 shares ARC filing was that they had a filing in the past. They refiled in April and sort of put themselves in what they said was first in line. Since then, obviously, we've had the big BlackRock news, the big BlackRock filing that sort of shook things up a bit. And then, any number of issuers coming in after that, Invesco, Fidelity, WisdomTree, et cetera, et cetera. So there's a lot of people, or a lot of issuers competing for.
With the flurry of filings, is that part of the reason the SEC is taking more time? There's a sense, as Kathy Wood has been saying, that there could be a number approved at one time, and that could prevent what you saw with BITO, just one issuer getting a ton of flows and the rest kind of being left behind. Does the SEC have an incentive to level the playing field here?
That's a really interesting point, and we don't quite know how it's going to play out in terms of whether or not the first issuer that files gets to go first, which is something that we did see with BITO. So there are other Bitcoin futures ETFs, and you can't compare them because the assets just aren't there as much as they are in BITO. I think BITO has something like $1 billion in assets, around $1 billion. The others are something like 30 million or 50 million. So it really doesn't compare in that way. And so there is a thought out there that potentially the SEC might not want to have that same type of thing happen again. It's just a theory, maybe something that we just hear on Twitter. So we'll see really how it plays out.
All right.
All right. Thanks to Bloomberg's Valdana Hayek. Thank you so much. Still ahead, we're going to drill down into ultra-short government active ETF with Jerome Schneider of PIMCO. Next, this is ETF IQ on Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Shonali Bassick.
And Eric Balchunas from Bloomberg Intelligence is back with us for today's drill down, where we're going to focus on one ETF here.
Shonali, thank you. Today we're looking at BILLS with a Z, PIMCO Ultra Short Government Active ETF. The name really tells you what you need to know here. Very, very short-term government debt or agencies it's going to invest in, and it's active. That's the key. You know PIMCO is an active manager, so there you have the yes there. The fee is really low, 14 basis points. That kind of separates this. There's a couple cheaper, but this is really on the low end. 14 bips for active management, again, is on the cheaper side. Let's look at this sort of allocation here. And this is going to hold basically, look, it's very U.S. government The duration is going to be very low, and AAA. So again, a very, very safe kind of ultra short-term Treasury ETF, but again, actively managed, trying to squeeze out maybe a little extra return there. Let's look at it versus SHV. This is an ultra short-term passive ETF from BlackRock, very popular. People use this all the time. My guess is this is going to try to eke out more return than that. So since it launched in June, it is beating it by 2 basis points, although they're very close. You can see the 2 lines here. So I think, look, Matt Shinali, the returns are going to be important here, but also is the stability. This is really something to park cash in, I think, and with that low fee, that could attract some investors.
Thanks, Eric. We're going to talk more about this ETF with Jerome Schneider. He's the head of short-term portfolio management funding at PIMCO. Thank you so much, Jerome, for joining us. If you take a look at bills, it's interesting because you've seen such incredible volatility at the short end of the curve. How important is it, and how do you choose what you will be investing in through this ETF, given the range of kind of repo to short-term rates?
It's a great question. I think when you take advantage of what we have come from and where we're going to, is that we're going to see relatively high short-term rates for a pretty long time. You know, we believe we're on the verge of a less synchronized world, perhaps one that's punctuated with a little bit of volatility. Investors have been looking for higher yielding and how to capture it. They're doing that at the front end of the yield curve. So we've seen a good amount of demand in those capital preservation strategies, everywhere from owning T-bills directly to even being in money market funds. What bills, BILZ specifically, looks to do is to be an active manager in that space, looks to try to find optimization and relative value between those high quality asset classes, being U.S. Treasuries, specifically T-bills in the front end, agencies, as well as looking at allocating to overnight repurchase agreements, which are collateralized by both government securities as well as U.S. Treasuries. What's important here is that even though there is a certain amount of high yield at the front end of the yield curve, there is actually some relative outperformance that can be had. And what we are seeking to do is bring that expertise, which PIMCO has given to its clients in that short-term universe, into a high-quality, highly liquid capital preservation strategy, which can hopefully bring some outperformance to those traditional T-bill type of allocations over the medium term. And that's really the trade-off and the opportunities that we see here versus traditional money market and capital preservation strategies.
So how much outperformance are you looking to harness, Jerome? How much hot sauce do you put on these bills?
Yeah, there's not a lot of hot sauce in the sense that you're adding more risk. Again, it's focused on that capital preservation. What we're seeking to do, though, is getting out of the accounting mindset that money market funds have of buying and holding an asset and holding it to maturity, and instead looking at the relative value opportunities consistently between the complexes, between owning T-bills, which can trade either higher yields or lower yields, to overnight repurchase agreements or benchmark rates like SOFR. These are opportunities which allow for total returns to actually be higher than you would typically earn in the traditional income sense in a money market fund. And so as a result, it could be a handful of basis points or it could be tens of basis points over the course of a cyclical horizon. And so when you're in an environment which is focused on capital preservation, uncertainty, and balancing that, the active approach is one that which brings a little bit more total return potential to our clients. And as a result, we're bringing this instrument to the broad-based investor populace.
So, Jerome, this product makes a lot of sense to me, especially for that fee. That's lower than most money market mutual funds. But money market mutual funds grew by about $600 billion in the first 2 quarters of this year. That's a ton of money. Do you think that institutional investors in particular overrate that fixed dollar NAV of a money market fund? What would you say to try to sort of peel some of those off into this fund?
Well, we think that investors have been really focused on that $1 NAV as a security, as a safety blanket. But we're also finding is that, with the evolution of the SEC's money market reforms, the focus on prime funds continuing to be in the spotlight going forward, that there's a continual rotation that will happen as we get the spotlight shifted from focusing on the credit risks and the liquidity risks within prime funds to being more conservative stance. But yet, there's a different opportunity set here. Yes, we're focusing on total return, but we're not maneuvering our eyes or shifting our eyes away from that capital preservation. So we just think there's a better way to be in the mindset of capturing the yields at the front end of the yield curve, in this environment. So we do think that over time, we're going to be able to differentiate ourselves in this relatively conservative landscape, but do so without sacrificing quality for sure.
Jerome, You mentioned at the beginning of this conversation that you expect things to potentially be choppy, that you expect it sounded like a higher for longer kind of situation. What are some of the things that may happen in the next couple of months that would keep this idea to be true?
What we're finding is that investors are really focused on how to create risk-adjusted returns, which makes sense for uncertain economic outlook. And in that landscape, this is exactly where active management plays out. Having the resources to underwrite credit risk, looking at different, more diversified portfolio approaches. This is exactly what PIMCO ETFs has done over the past few years in being very deliberate in evolving our platform to really focus on multi-sector strategies, active management approaches, where we think that there's not only better solutions which our clients can afford, but also mirror those with client demands. And that's why we have exactly done that, offered 6 new ETFs in the active management landscape over the past almost 18 months or so. From that perspective, though, I think what we have to do on a go-forward basis is look at the economic landscape. Sure, things like inflation are still a question mark. We have a Federal Reserve which is going to be incredibly data dependent, and that data dependence translates to hopefully our clients having the optionality to maneuver and pivot and create a more balanced approach to their asset allocation resources. And that includes taking advantage of the higher yields across the yield curve, not just at the front end that we're highlighting in bills, but going out and beyond that in terms of our new products like P-Yield, PYLD, et cetera. And so from that perspective, we think that this uncertainty and the volatility which may emanate as we get later in the year from this uncertainty might create opportunities to be a little bit more flexible along the way.
Jerome, thanks so much for joining us. Pleasure having you here. Jerome Schneider there of PIMCO talking to us about bills. I'm Matt Miller for Shanali Bassicanero. Balchunas, this is Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lyons deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I'm John O'Lookman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets at this hour. We do see the S&P 500 putting up some gains again today, just about 0.4%, 44.82. That's not the exciting part. To me, this starts getting cool. 10-year yields. This morning when I came in, we were at 4.20 even. So pretty strong, pretty rich yields there. That's attracting investors into the dollar. And we've had a really good string of trading sessions for the Bloomberg dollar index. We were up to 1240 this morning. Right now we're off that a little bit, but still at 1236.58. You can buy 145, more than 145 yen for the U.S. dollar right now. That's a sign of its strength. A lot of it having to do with these higher yields. And then take a look at NYMEX crude. Right now it's down, but it's climbed steadily over the last week. $82.34 is the level for 1 barrel of West Texas Intermediate. John, what are you watching?
Well, first of all, you're right that oil, that weakness there is leading to weakness, let's say, in energy stocks. But generally speaking, the willingness on the part of investors to move back into tech can be seen through names like NVIDIA. The NASDAQ 100 is having its best day in a week, and NVIDIA is at the top of the charts in terms of percentage gains today after some recent struggles. Then you've got the steel story and names like Steel Dynamics and others, and you're seeing that trend with Canadian steel stocks, too, rising today on the U.S. Steel thanks but no thanks to Cleveland Cliffs, and the CEO Cleveland weighing in on an interview with Bloomberg. We're going to get more from Joe Doe coming up later this half hour on the steel sector excitement today. And then some specific stock stories, Matt, just to get to as we continue to watch the situation unfolding in Maui. There is weakness in Hawaiian Electric shares right now as people try to put the pieces together on whether power lines are connected to that story. And we're watching the two AMC stock stories. AMC itself down substantially as they got court approval for that stock conversion plan, which helps those preferred APE shares, but does weigh on the traditional AMC stock, Matt.
All right, we'll continue to pay attention definitely to those two stories. Meanwhile, traders are betting that interest rates in the U.S. will remain higher than inflation for much longer, sending the 10-year Treasury yield to its highest since last year. Let's discuss with Bloomberg's Liz McCormick. She joins us here in studio. Liz, thanks so much for joining us. Really exciting day, right? We saw Treasury yields shoot up again today, and the Bloomberg Dollar Index was just up like a shot as well. Is that really what it is? Are investors, international investors, saying, hey, the U.S. economy is going to outperform other economies, and those yields are rich. Let's get over there.
Yeah, exactly. Remember, a lot of us thought for a while the dollar was dead this year, right after last year, and now it's like the U.S. economy is hanging in. We've got this soft landing narrative, and there's a lot of people thinking maybe the Fed, is going to have to stay higher for longer. The Fed has said that. Nobody believed them. People are starting to pare back the cuts priced in for next year now, and I think people are saying, yeah, geez, you still can't beat the yield in the U.S. So like you said, let me look at the dollar yen, look at some of these currency pairs and the dollar index. Yeah, I think it's like U.S. rate, strong economy. You can't beat it.
And I guess, Liz, just to further clarify, the idea of higher interest rates for longer is one thing, but also the idea that possibly we could see the end of a tightening cycle and still interest in the dollar if the rate level is exceeding, let's say, the level of inflation?
Right, exactly, John. Real yields, real yields. Remember, it was a year or so ago, we were talking they're negative and what's going on? Why would anyone want to buy them? Now you've got, 10 and 30-year real yields bucking up towards 2%. And that's pretty attractive. If you lock that in, it's kind of talk about totally risk-free. So I think that's what people are thinking as well. The Fed, done a lot to bring down inflation, but they're not going to give it up. Even if they hold rates high, you should see those real yields stay juicy, because if inflation even slowly ebbs off, you still have a high real rate, and that's your kind of ultimate North Star for currency pairs is real rate. So I think that's just got, the dollar got a mojo again this year, right? At least in recent weeks.
Where do people go on the curve? I saw a story last week that the 20-year, the popularity is impressive, and the yields are higher, right? 443 right now, 444 on the 20-year, which is, still almost 20 basis points higher than the 30.
Right. There's a lot of history with the 20-year. They relaunched it a few years ago. It was kind of bigger than the market wanted. It, you know, trailed off and always had a higher yield, and people didn't like it. But now they're saying, hey, like Jerome Schneider of PIMCO was saying, I know he's talking bills, but saying go out the curve a little. People going really out the curve are saying, well, why don't I buy a 20-year? Because the yield is much juicier than the 30-year. It's, you know, I think rates are going to come down eventually. But yeah, the 20-year is a special bird, but the Treasury would be happy that people like it now, so.
All right, Liz, thanks very much. A helpful breakdown. Liz McCormick joining us. So we'll continue to track those trends, but this is also a week where we're getting plenty of U.S. retail data to give us a better sense of consumer spending and household finances. And let's get some more perspective from Kayla Bruin. She's a senior economist with Morning Consult to talk about that. And Kayla, I guess if we're talking about a higher interest rate environment for longer, the first question I think a lot of people have is how is the consumer going to navigate through that? What are you seeing right now?
So good afternoon. Thanks for having me on. I think what we do is we ask a lot of questions of consumers, my team, and some of what we've seen in spending lately, if we're looking back over the past few months, has definitely aligned with what we've seen, sort of this positive news so far when it comes to the resilient consumer with their spending. Looking ahead, though, I do think there will be some headwinds, and particularly tied to interest rates, as you mentioned. The debt burden, I think, is going to be a bigger issue, especially heading into the fall. Not only are we already seeing that credit card interest rates are higher as debt balances are increasing, but the student loan repayment pause is another headwind. So there are a bunch of debts coming due, so to speak, that the consumer hasn't necessarily had to fully face yet. And I think we'll start to see a little bit more of that heading into the fall.
And you often hear some of the retail experts talk about the trend of trading down or maybe getting more for your money. And this is going to be a big week, obviously, to hear from some of the giants in that area, like Walmart reporting its quarterly results. Is there anything you've been noticing in the numbers that are associated with that trend?
Yeah, so I'm really interested to see what Walmart says in their earnings report this week. What we've seen in our data, where we ask consumers what they've been spending, is sort of a positive trend in terms of how much they're spending the past 3 months compared to the months before that. So that would look good for these retailers' earning reports, particularly with the growth that we've seen in goods categories. But when it comes to trading down, I know that's something that Walmart has called out as something that's benefited them when we've seen higher income consumers trading down into Walmart as opposed to Target or Whole Foods or wherever they're used to shopping. They're going and looking for better deals for groceries. We've actually seen a decline in our trading down indexes, and I'm kind of curious to see whether Walmart is seeing that as well. They're maybe not having that tailwind anymore from the higher income consumers, or whether it's maybe a sign that those consumers have actually fully adjusted their baseline with prices as high as they've already become, and maybe they consider Walmart the new baseline as opposed to the previous places that they shopped, and they're maybe there to stay.
August 15th, Home Depot, Walmart on August 17th, August 24th, Nordstrom, Dollar Tree, The Gap. We're starting to get towards September, Kayla, and a lot of parents are going to be putting their kids back in school. Are we going to see a big back-to-school season, or are higher rates and kind of looming student debt repayments going to put a cap on that?
From what we've seen in our data so far, it seems like there still is some momentum in spending for goods categories. I would also say I think a lot of the back-to-school shopping has already started for some of these consumers. Amazon Prime Day is a big shopping day, and the question I think with a lot of the retailers that we'll see this week, particularly ones like Target, Nordstrom, ones that are maybe targeting a little bit of the higher income groups, how much of that spending that we've seen consumers are saying they're still doing, how much of that has been e-commerce as opposed to more traditionally brick and mortars? How much did Amazon get versus Target or Nordstrom in the back to school? But I do think through the end of the summer with the back to school shopping that we've already seen, there does seem to still be some resilience. We're still seeing consumers saying that they're spending more on these categories.
You talked about credit card debt. People are running larger balances, Kayla, and delinquencies are rising on that kind of debt, on auto loans. Are you starting to see the charts look alarming?
The thing that's preventing me from being too alarmed by what I'm seeing is really the resilient labor market. Real incomes and real wages have managed to come up above inflation. That being said, the labor market trend is definitely towards slowing, and with inflation, I am a bit concerned that some of these good categories that had been helping inflation slow, some of those prices could start to pick up, things like groceries and gas, that we may see a little bit, tougher inflation there, a little resistance to getting back down to the 2% target. So really looking at that wages versus prices growth in the next few months, I think is going to say a lot about the direction of how consumers are able to manage their debts and their spending.
All right, Kayla, thanks so much for joining us. Kayla Bruin there, Morning Consult senior economist, talking to us about the U.S. consumer. Coming up, U.S. steel shares are surging after rejecting a takeover bid from its rival Cleveland-Cliffs. We'll give you the latest on that M&A story next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. Shares of U.S. Steel surging after the steelmaker rejected a takeover offer from rival Cleveland-Cliffs. U.S. Steel now working with bankers to review its options. The CEO of Cleveland-Cliffs telling Bloomberg he thinks ultimately a deal can get done. But either way, Matt, this speaks to a fairly long transition U.S. Steel has been going through, which clearly, at least in the eyes of investors today, is now paying off.
Yeah, absolutely. That is, I think you're referring to the Big River plant, right? Putting investment into bringing their steel production to the modern era. Bloomberg's Joe Doe covers all things metals and machinery for us. And Joe, I think this is a fascinating story. All weekend I was wondering why they didn't just take the offer. But of course, you always want to do a little negotiation and try and get a few dollars more. Yeah. Isn't this fully valued for U.S. Steel?
Yeah, I think the question is exactly what you're saying. Like, what's the problem with the premium, right? I was talking to somebody at lunch today who said, yeah, the premium looks actually pretty good on this thing. But I think really at the heart of this is more this question of antitrust, right? Talking to various people in the market yesterday and today's sources saying, listen, if you put this combined Cliffs and U.S. Steel together, suddenly you have one company that has all 100% of domestic iron ore reserves. You then have a dominant position in the automotive exposed steel sheet market. And then there's other things like the tin mill market. And there's also questions about non-grain-oriented electrical steel. There's all these things that basic investors probably don't know about, but they're the real questions, I think, at the core of whether or not this deal, even if both sides agreed to it, would actually get through the Department of Justice.
Something to watch. And Joe, by the way, along with getting a helpful history guide on the Andrew Carnegie, JP Morgan early days of this company in your great story today, you also highlighted, and we got that commentary from the Cleveland-Cliffs CEO, the Steelworkers Union itself and how that might play into this story from here. Can you just remind us of that part?
Yeah, quite simply, the United Steelworkers can step in and say whether or not they want this deal to go through. I was actually on the phone with Tom Conway this morning. He's the president of the United Steelworkers, and he said, listen, Joe, we support this deal. We like what Cliffs has got. We like what Cliffs has done for the union. You got to remember, just in the past 2 years, they had a whole new union negotiation, and Cliffs basically gave the union many of the demands that they had asked for. There was a little bit more of a struggle with U.S. Steel. So I think that's a key part here is, and Lorenzo has said that himself. He said it on Bloomberg TV earlier today. He's got the support of the union and all the workers there. So, yeah, I think that's one of the big things that people had been talking about overnight, but it does seem like that one's, at least for now, in good position for Cliffs.
It's absolutely fascinating.
Okay, well, lots.
I mean, I just want to quickly ask. The old way of making steel is pretty much gone for Nucor and Dynamic, but for these guys, they still do that. Yeah, they still do it in the 1920s production version.
Yeah, I mean, quite literally, Mon Valley, which is owned by U.S. Steel, still traces its roots back to the 1900s and Andrew Carnegie. I mean, this is still an operating steel mill, still very much there, just outside of Pittsburgh. And it's not just them, right? This is how it's done in China. This is how it's done in India. Integrated steel making is still, especially if you want that high purity of steel for automotive and any other high application, that's the way to go.
Joe, great stuff. Appreciate you breaking it down for us. A lot of breaking news that we've been tracking on this one today. Joe Doe joining us. We'll continue to watch the U.S. Steel story. Coming up, U.S. mortgage rates continue to climb, limiting affordability as traders see higher rates for longer. We'll dive deeper into that story. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about
how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Matt, obviously we're watching the real estate market closely with mortgage rates rising for a third straight week in the U.S., now approaching 7% according to Freddie Mac. Rates hovering around 7% have kept would-be buyers on the fence, discouraged current owners from listing their properties for sale. We want to dive deeper into the story. Archouse Managing Partner Gabrielle Kane joining us, as well as Bloomberg Shanali Bassick. And Gabrielle, I'll start with you. Thanks for the time. And, you know, it's interesting up here in Canada, we have these 5-year mortgages. So there's a lot of people who are more quickly moving through this reality of higher rates. But I guess those who have these 30-year mortgages stateside are wondering and waiting it out. What are you seeing in terms of the trend of the impact of rates right now on real estate?
Yeah, great question. Firstly, Matt, thank you so much. Shanali, thank you guys very much for having me on. Maybe it would be helpful to give like a little bit of background on Archouse. We are an opportunistic real estate investor that's recognized a big dislocation in pricing for real estate between the private and public markets. And recognizing that dislocation, we've decided to raise private equity to try and meet the public market at big premiums and deliver big premiums to public shareholders after establishing a position in the public company and sometimes using shareholder activism tactics to compel those companies to privatize. And of course, interest rates have been a huge theme in contributing to that dislocation over the last couple years.
Well, continue on that, because there were two very high-profile situations that you were involved in. Preferred apartments in the Columbia Property Trust, one sold to Blackstone, one sold to PIMCO. Fast forward several months later, and you're watching Columbia Property being one of the more high-profile investors here defaulting on mortgage portfolios. Do you think that when you look at the REIT space, public or private at this point, there's a lot more pain to come given the trajectory of rates?
Yeah, that is a good question and a really good point. The Columbia Property Trust privatization was our first foray into the space, and we kind of recognized a lot of pain in office in general, public shareholders very nervous about return to office, and just really highly discounted that stock. We had private investors that had an interest in buying that stock at a premium and buying the company and all of its assets at a big premium, and we were able to deliver to shareholders that 40% premium or so, and over those two deals, I think we unlocked about $1.3 billion of shareholder value.
So how much more of these deals can you see? Are you currently in dialogue with a number of other REITs and companies that are publicly traded that could be experiencing some of the same pains we saw in those situations?
Yeah, we are. And basically anyone with a real estate portfolio today, certainly to the extent they've refied or financed over the last decade or so, and they're still holding those loans, are likely going to be facing maturity walls and pain resulting from this wild increase in rates. Today we have in our top 10 targets or so, $15 billion of unrealized equity. And a lot of that is coming from a view from public market investors that real estate is kind of going to be in pain for the near to midterm. And to the extent you can come with a private equity buyer that's capitalized differently, potentially with new debt at lower, more conservative levels, they can often give those public shareholders that big premium and execute that win-win.
How much has that, I mean, we've seen over the last year a real shift from bank lending to private credit. How much has that played in your favor?
I would say it's certainly a component of these new capitalizations that are coming to bear. There is still, in our view, a big vacuum on the lending front that will probably expand in the coming quarters and potentially years, hopefully to be filled by those private equity credit providers.
One of the other factors we're watching, of course, is the regional bank exposure more broadly to real estate right now. I imagine you're watching that as well. Is there anything in particular you're watching most closely?
Well, regional banks certainly are, to your point, incredibly exposed to real estate. And it's concerning for a couple reasons. Almost more than it is concerning because of credit or value deterioration, it's really concerning because of rate expansion. As we described, there's been wild explosion, of course, in the Fed funds rate and in turn in borrowing costs. So this mismatching that's kind of implicit on banks' balance sheets between short-term liabilities and long-term assets can create a really scary spiraling of problems, cascading of problems for banks, not dissimilar to what happened in the case of Silicon Valley and First Republic Bank.
30 seconds here or so. We've seen the office story be pretty pronounced and very public. But what about homes? Do you think that some of these troubles that you're seeing in the real estate sector floods into homes in ways that people don't see? We only have about 30 seconds here.
Yeah, so I think the multifamily housing market certainly is at risk of a lot of those same rate issues. I would say that what homes benefit from, and multifam, but single family housing as well, that office doesn't, is top line revenue growth that can offset that inflationary concern. Right, so housing prices have really expanded over the last couple of years. So to the extent there is pain, it's most likely because people really bid down cap rates to, unsupportable levels over the last couple of years and took on short-term debt that they now need to refi.
Gabrielle, thanks so much for coming in. Great to have you on the program. Gabrielle Kahane from Ark House, as well as Bloomberg's Shonali Basak, our star Wall Street reporter. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg TV and radio.
Low volume here in the U.S., but fireworks overseas. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. You look at U.S. equities right now, the S&P 500 is higher, Russell 2000 is lower. Mega cap tech names leading the way up for the broader market. But really, the tone was set in Asia trading, and it was pretty downbeat with the MSCI Asia Pacific Index off 1.4% on persistent concerns about China's slowing economy. The real action, though, is in the bond market. Yes, we're only looking at a small minimal move here higher in 10-year yields, but we're looking at the highest yields so far this year and in the range of where they were during the great financial crisis. There's a lot of concern about the market's ability to absorb a ton of treasury supply this quarter, and of course, little reason to expect the Fed to cut rates anytime soon. And of course, we're seeing the U.S. dollar march higher. It's stronger versus all the major currencies. Dollar yen broke through 145, as you can see, sending the yen to a level that last year prompted Japan to intervene in the markets. Romaine?
Yeah, 4.17 on that 10-year. At one point on the day, we were trading above a 4.2% here on that 10-year yield. And when you factor in inflation, you got a 10-year real yield that actually at one point surpassed 1.82% on the day, back to the highest since 2009. The uptick in real yields putting a lot of air under the dollar, up about 3% over the past 4 weeks alone, outperforming all of its G10 peers over that stretch, including the yen, which you just had on that board, weakening at one point beyond 145. The dollar also outperforming every notable EM currency, including a 6% gain versus the Argentine peso. And indeed, Argentina markets really swooning here today after Libertarian Congressman Javier Milei took the lead in that presidential primary election over the weekend. The peso weakening for a 580th straight day versus the dollar. Yeah, you heard me right. I had to double check that stat when I saw it. The benchmark foreign debt also sliding to less than 30 cents on the dollar, and the main U.S. ETF that tracks Argentine stocks here in the U.S. falling as much as 8% on the day before pairing about half of those losses. It's been a brutal start for investors over there to what could be the start of a new political era, and it's been a brutal start to the week overall for emerging markets. The MSCI Emerging Market Index now down 6% to start August, and today breaching that 200-day moving average. Of course, the biggest weighting in that index is China, where stocks there are down again. The currency weaker again, and Scarlett, all the talk once again is about a property sector and whether there's going to be some contagion risk for the broader economy.
Yeah, you said it perfectly. And let's start with Country Garden, which was what was once China's biggest developer, now on the brink of default. Here are two of its U.S. dollar bonds due over the next 2 years, and both, as you can see, have fallen deep into distress, now trading at about under 10 cents a dollar on the dollar. The fear is an increased risk of contagion, as you mentioned, Romaine, across that sector that would then spill over to China's broader economy. And we're already seeing clear signs of stress in the financial sector. Zhongzhi Enterprises Trust Unit delayed making payments on some high-yield products, which is partly why, if we change up the board, you'll see weakness in China's currency. This is the offshore Chinese yuan. It's now approaching 7.3 per dollar, the weakest since November. It's the worst performing currency in Asia this year after the Japanese yen. You can blame it on weaker than expected economic data out of China. We're talking consumer prices, wholesale prices, bank loans, exports, you name it. The PBOC has not taken taken any effective steps to support the economy and therefore the yuan as the dollar continues to strengthen? Romain?
All right, let's get straight to our first guest as we kick you off to the close. Ron Temple, he's the Chief Market Strategist over at Lazard, joining us right now in studio. Ron, great to see you here. We want to get to what's going on here in the U.S. markets in a second, but I do want to start off with China. More concerns here about weaknesses, I guess, overall about the Chinese economy. But when you look at the property sector, when you look at some of the moves that China, the government has taken or maybe not taken to try to stabilize things here, do you worry at all about the potential contagion risk for the second largest economy?
Yeah, it's less contagion risk that I'm focused on right now than just the absolute issues in China. And if I think about it, one of the things I watch most carefully on the Bloomberg terminal is just Chinese consumer confidence, which is basically a tiny bit off the record low. This is a survey that started in 1996. We bounced after the reopening, post-COVID lockdowns, and it's just fallen right back over to those all-time lows. And I think that's really driven by the real estate issues. I mean, if you look at the household sector in China, the single biggest asset on the vast majority of households' balance sheet is their house. Now, you might be thinking, well, isn't that true in the U.S. and Europe? Kind of, but not really. In the U.S. and Europe, we're really wealthy countries. We have a lot of financial assets on top of a house, like your pension plan, your 401k, et cetera. In China, really, the house is the nest egg. And when we've seen as home prices going down for the last 2 years across most cities in China.
Yeah, well, as Country Garden reels and as Scarlett mentioned Zhangji's, this now becomes more of a financial issue at a time where I think a lot of U.S. investors, and for that matter, European investors, have tried to diversify away from the Chinese market. And I'm wondering if that correlation that used to exist, where you saw weakness in the Chinese economy, that meant weakness for most of EM and even for some of the developed market. Is that correlation still there?
I think it's less correlated than it used to be. There's truly a linkage between Chinese infrastructure investment, fixed asset investment, real estate, and commodities. But the EM market has become much more diversified than it used to be. In the old days, we thought of EM, you thought commodities and materials. That's really not the case anymore. So I do think that linkage is less strong than it used to be. But I do worry, by the way, I mentioned, household net worth and housing. These real estate developer issues are another problem. And the other one is really interesting is youth unemployment, officially at 21%. But some think tanks are now saying it might really be 45 to 50% youth unemployment because a lot of young people have just dropped out of the labor market. And just like in the U.S. and Europe, when you don't participate in the labor market, you don't count as being unemployed. So I think there's some real issues we need to watch in China. And so far, most of what the government has done has been tinkering around the edges. I think investors are waiting for that bazooka policy. I don't think it's going to come because back in the old days, it was almost always more credit.
Yeah.
The Chinese government doesn't want to pile more leverage on this problem.
Do you think China is trying to export its way out of this low growth environment?
I think they're using that tool, the currency tool. I mean, the currency is now down 8% since January. But China's economy is much more service-oriented and domestic now than it used to be. So even that tool doesn't work like it used to. So I think the Chinese policymakers have a real conundrum on their hands.
So what does this mean for U.S. companies, European companies with big operations in China, or that at least depend on that market for a big chunk of their sales?
I think it depends on what they're doing, right? I mean, what we've seen is the Chinese consumer did go back out and start spending money after the COVID lockdowns ended, but they haven't been making big ticket purchases. So if you're hoping to sell a car in China, that might be more challenging than if you're selling a basic consumer product. And so I think it's going to really depend on that. And I do think a lot of companies also are thinking about their supply chains, given the ongoing geopolitical tensions. And by the way, the fact that Chinese workers just aren't as cheap as they used to be. Wages have gone up a lot in China, and there might be better places to produce as well outside of China from a labor cost perspective.
With all the focus on China, of course, there's still a big focus on what's going on here in the U.S., an economy that I guess is still standing strong. Is that how you would interpret it?
Yeah, it's tough. I think it's always relative to expectations, right? I mean, if you told me 15, 18 months ago the Fed would raise rates 525 basis points and shrink their balance sheet $936 billion, I would have said, wow, how bad's the recession? And it is amazing, if you look at the second quarter GDP at 2.4%, how resilient the economy has been. And I also think the Fed is successfully threading the needle. Inflation is down from 9.1% to 3.2%, and yet we're creating 258,000 jobs per month year to date, which is twice what we need given population growth. So things are looking good. That said, even if we dodge a recession next year, I think people need to be a little more grounded and recognize we're still going to have really slow growth. I mean, consensus is 60 basis points of real GDP next year. If we get lucky, is it 1.5? That's still pretty slow as all of these tightening effects work their way through the economy.
Ron, I'm going to have to leave it there. Always great to catch up with you. Ron Temple, the Chief Market Strategist over at Lazard, helping us kick you off to the close with an eye on the financial markets and an eye on the tragedy that's still underway out in Hawaii. We're looking right now at the federal response to the wildfires in Hawaii. Let's listen in as the FEMA Administrator, Deanne Criswell, updates us from the White House.
Here on the ground. I met with some of our federal officials that have been deployed, and I also had an opportunity to talk to survivors and hear from them really some harrowing stories of survival as they evacuated from the area and sought shelter. While we are here and as we continue to closely monitor the situation on the ground, we are continuing to prioritize the safety and the well-being of the Hawaii residents in coordination with our state officials and all of our federal partners. As residents continue to mourn the loss of their friends, their loved ones, their neighbors, the loss of their homes and their way of life, we know and let them know that we are mourning with them. Nothing can prepare you for what I saw during my time here, and nothing can prepare them for the emotional toll of the impact that this severe event has taken on them. And as you heard, I have been in continuous communication with the president since these fires started. I have been giving him updates and his team updates, letting him know what the federal family is doing to support everything that Governor Green has asked for. A part of that, at the request of the state of Hawaii, FEMA has activated our Transitional Sheltering Assistance Program, which is now available for eligible residents who were displaced from their home. This is FEMA's hotel program, and this will allow them to move from shelters into pre-identified hotels or motels temporarily as they develop their long-term housing strategies. This is in coordination with the governor, as he has also stood up a program to provide Airbnb rooms or other hotel rooms to support residents. And we will be working in close coordination with each other to make sure that everyone finds a temporary solution as they begin to develop their plans for rebuilding. We're also focused on getting funds into people's hands so we can help with some of their critical urgent needs. This is called Critical Needs Assistance, and it provides $700 initially to provide food, water, first aid, medical supplies, other just critical needs that they need right now. This is in addition to what they will also be able to be eligible for in cash assistance for the loss of their homes or the loss of their personal property. So I encourage anybody who has not registered for FEMA assistance yet to go to disasterassistance.gov or contact 1-800-321-FEMA to get into the system and start this process. We also have over 300 personnel on the ground. Many of those.
We're listening right now to Deanne Criswell. She's the FEMA administrator here in the U.S. She is in Hawaii, broadcasting through the White House here as we keep an eye on the wildfire disaster there. Dozens of folks dead, many more missing, and thousands of people now homeless. We'll keep an eye on that story. Stay with us. This is Bloomberg.
For this area and to make sure that we are successful in providing relief to survivors. We also want to make sure that we are getting all of the
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
on the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
A lot of action in emerging markets today. Let's start with Argentina. The country's bonds, the peso, the stocks, all in a free fall. This after Javier Milei, a congressman and an outsider, pulled off an unexpected primary win in those primary presidential elections over the weekend. Sherry Ahn joining us right now, our emerging markets correspondent, to talk a little bit more about this. And I think for a lot of folks outside Argentina, Milei wasn't on anyone's radar.
Yeah, he really wasn't. The expectation was that we would see some sort of gains by the center-right candidates or even the existing government ruling party. But right now, with Javier Milei now being a front runner for the October elections, uncertainty has just risen in the markets. We're talking about a libertarian outsider, as you said. He has really talked about abolishing the central bank. He's also talked about wanting to dollarize the Argentinian economy, reducing government spending and taxes, privatizing public companies, and his rightist agenda seems to resonate with Argentinians. And we have seen, of course, really Argentinian assets taking a hit. Now, policymakers had to devalue the Argentinian peso, an 18% devaluation that sent the peso to around that 350 level. And when it comes to a parallel market, we're even talking about a weaker 680 pesos per dollar. And really, as the current administration is running out of options, is running out of money in order to defend their exchange rate, the central bank had to hike rates to 118%, which is 21 percentage point lift. Really, the concern right now is that we're going to fall into this spiral of devaluation and inflation.
Right. I mean, he's such a colorful character. He's an economist. He has a bunch of dogs that he's named after economists as well.
Milton Friedman being one of them.
Okay. Does he have a chance at winning?
Right now, we are expecting it to go into a three-way race. The concern right now for investors is what happens when the uncertainty gets delayed. The October 22 elections could actually go into a runoff in November. Some analysts saying, look, still right now, the number two in the primary results, Patricia Bullrich, actually didn't do too bad. She could, in fact, take the candidacy and become elected, and she is center-right, and that might give a little bit more relief to investors. But the uncertainty for now continues, and Argentinian assets are taking a hit.
I am curious, though. I mean, a lot of his policies are certainly unorthodox, to put it mildly, but this is also a country that has tried some relatively orthodox policies over the last, I don't know, 3 decades. And, well, we've seen the number of defaults and other sort of agita that they've given markets in the past.
We have seen them really try to work with the International Monetary Fund in really trying to win those funds. But we've also seen some of those projects and initiatives in Argentina that haven't gone well. For example, pegging the Argentine peso to the dollar in the 1990s, that was not a good experience for them. And hyperinflation is in their history. So we continue to see.
Does Milei support that, though? I thought he wanted to
dollarize the economy.
He does want to dollarize it.
So we are trying to figure out what an Javier Milei presidency could potentially look like. So far, economists and analysts are saying, hold off. We still have the October 22 elections. We might potentially get a runoff. But in the meantime, could Argentinian policymakers and people in government take more drastic measures in order to get those votes is a key concern, as Sergio Massa, the economy minister and, of course, of the ruling party, did not necessarily fare that well, coming in third on Sunday's primaries.
All right. right, Sherry, thank you so much for getting us up to date on what's going on in Argentina. Bloomberg's emerging markets correspondent, Sherry, on there. Let's stick with the EMs and turn now to China, because Tesla is rolling out a new round of price cuts in the country, reigniting fears of a price war following similar moves by a host of automakers in Asia just last week. Let's bring in Bloomberg Detroit Bureau Chief David Welsh with the story. So, David, this is what, another round of price wars in the auto sector in China?
It is, particularly with electric vehicles. Tesla saw its deliveries in July drop by 31%. So this and BYD and some others had very good months. So it's not like this is just Tesla that's been, or rather, the whole industry. It's just Tesla that was suffering in the EV market for the month. And I think they're reacting here by trying to lower prices and keeping sales going. They have a lot of production. They have production coming online in the U.S. that's still been ramping up. So overall, the company is guided toward production being down in this quarter because of some changeover at some plants. But I think maybe it's also because they're seeing some slipping demand and growing inventories. And you react with price, and that's where they are.
And give us some sense here, because they've done this before, but they've also then raised the prices. There's kind of been this, I know he's sort of joked on his social media platform, this is kind of like real-time pricing, if you will. But it seems that there seems to be some indecisiveness as to how they're doing this.
I think it's more, I'm not sure they're being indecisive. I think they know they've needed to lower prices from where they were 6 or 12 months ago. What they're doing is when they do raise prices again, it's usually by a much smaller amount than they had lowered them by. So they're trying to find the sweet spot. They don't want to lower prices. They don't want to give up their margins. So if they do and it spurs demand a little more than they thought, I think they try to claw some of that back a little bit. Or they're also reacting to what competitors are doing in the market. It's just, I think the EV market's a little different than the rest of the vehicle market in that it's just more dynamic with new players coming in, more production coming in, and demand being less certain than it is with internal combustion vehicles. It's a new market, so there are a lot of dynamics at play. Remember, Tesla had a monopoly on this practically just a couple of years ago, and now they've got more competition and a lot more competition in China, so it's tougher to get the pricing right.
Yeah, that first mover advantage slipping away a little bit there. David, thank you so much. David Welsh joining us from Detroit. Now, coming up on Bloomberg Markets, The Close, the recent turmoil in the U.S. banking sector is creating new opportunities for private credit. What that means for investors and consumers alike. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, as banks across the U.S. shore up their capital following the collapse of Silicon Valley Bank, the fallout from the regional banking crisis, it's private credit funds stepping in to fill that void. They're trying for new opportunities out there for financing and, well, financing some creative things. Bloomberg's John Sage joins us right now with a little bit more on this story. And we've seen the ascent of private credit and private equity, for that matter, over the last couple of decades. It was pretty straightforward for a while, John, but I feel like there's a lot of money out there and they have to find new opportunities. Some of those opportunities quite far afield.
And especially as you see the reduction of deal flow overall across Wall Street in general, with higher rates and businesses, private equity firms trying to figure out how to actually swallow that very, very large interest rate challenge, the private credit space has said, let's go find new places to go and deploy.
Let's go find new places, and they're picking up the slack because regional banks are, of course, holding back here on loans as they have to not hoard cash, but really be mindful of making sure they have enough cash on hand to meet increased regulation. Can you tell us a little bit about what this means for the companies that are being extended the loans?
In a lot of cases, it means in many cases, it means higher prices because banks and the bank syndicated market is efficient at driving down prices. There's a lot more players, and in a lot of cases, a lot more capital, where some of these businesses do have to deal with swallowing that much higher interest rate or interest charge. But in a lot of cases, too, private credit conveniently or in a lot of great ways is able to help these businesses manage a lot of that or manage through a lot of those potential hiccups with the customization and some of the ways that they can get in and get creative with different types of financing.
Well, let's talk about the exit strategies here, John, because the whole sort of business model of private credit and private equity is to have that equity strategy. And we certainly know, particularly when it comes to private equity, that opening just hasn't been there.
Right, and it's going to be interesting as we go forward, where there's a lot of this pressure, especially on private equity funds, and coming from their investors saying, you haven't given us the money that we would have expected to have in a normal rate or I guess normal economic environment. So in a lot of ways, we're seeing a lot of that pressure starting to build, but the deal flow just still doesn't necessarily make sense because with rates still being so high, it makes it so much more expensive to first buy some of these businesses, but also having to deal with the cash flow management and some of these things every time one of these new businesses trades hands. So it's been unique to see how with banks also pulling out of this market, especially from a buying and selling perspective, private credit has been really able to step in and say, we can work with you and we can find the right way to make some of these acquisitions happen.
Yeah, of course, they have a lot more flexibility than some of these banks without that regulation. But of course, that could be the bugaboo as we move forward. John Sage, great reporting here at Bloomberg on what's going on in the private credit and private equity space. Meanwhile, we go back to the public markets here in S&P 500, up about 0.3%, Scarlett, on what is an incredibly low volume day.
Low volume day, but look at yields. They continue to move up. The 10-year yield 4.17%, or approaching that level, and the dollar has been strong across the board.
Yeah, of course, the big updraft there, some of this blowing winds in, I guess, from emerging markets, and obviously whatever the heck is going on with China and these property businesses. A lot more coverage coming up here. Stick with us. This is Bloomberg.
Okay, so you're moving in on me. Quick. You're distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets to close, almost 2:30 here in New York. Let's get you caught up real quick on what's going on in the commodities space. Abigail Doolittle standing by right now with our commodities close.
So overall, Romaine, we are looking at some weakness. We have the Bloomberg Commodity Index down for a third day. This, of course, is the Bloomberg Dollar Index is higher, pressing those commodities denominated in dollars down. New York crude down about 0.8%. It seems that the 7-week rally right now is sputtering, and that is at this point the longest rally since February 2022. Let's see if those oil traders can pick it up as the week goes on. U.S. steel, of course, surging up 32%, its best day ever. Steel itself, though, down ever so slightly, and I know that there's not a lot of connection, but just had to throw it in there. Wheat down 2.2%. Traders are looking past some of the Black Sea flashpoints, not too concerned about supply. And then finally, sugar down 1.2 clear. It's not really clear why it's down today, Romaine, but on the year, it's a really different story. Up 20%, up for a 5th year in a row. Clearly, the sugar traders not hearing about the fact that I have given up sugar, I don't know, almost 2 months ago.
Abigail Doolittle, a market mover in and of herself there. A lot of red on the screen. There is some green on the screen when it comes to U.S. Steel. Shares up about 32% right now. This after we learned that Cleveland-Cliffs made a takeover offer for the company of about $7.3 billion. A takeover offer rebuffed by the folks over at U.S. Steel. Joe Doe joining us right now, who helps lead our coverage on this. Joe, let's get to the heart of the matter here. Why does Cleveland-Cliffs want to buy U.S. Steel?
There's a whole host of reasons that Cleveland-Cliffs and Lorenzo Gonsalves want to own U.S. Steel. I think a part of it is U.S. Steel has some very interesting assets for the future. U.S. Steel has been transforming its business now for the past 5 years. Dave Bird, the CEO over there, came in when a lot of people thought that the company was headed towards bankruptcy because they had these old traditional mills, some of which had been around for dating back to Andrew Carnegie. But they went in and they bought these so-called mini mills, Big River Steel. They decided to double the capacity there. And a huge thing about those mills, in addition to making high-grade automotive steel, which is something Cleveland-Cliffs already does, but the integrated way, is that they're actually more efficient and a lower carbon footprint. Lorenzo Gonsalves has been getting hammered by investors and by customers over the past 2 years. You hear on all the calls. He's even been called out at conferences, people asking him in Q&A, hey, how can you tell us, or how are you actually going to get your green footprint better over the next few years, 5 to 10 years? And
this is the way to do it?
And this is going to be one of the ways he would do it if he can get this deal through.
All right, we actually spoke with Cliff's CEO about the bid and the rejection of the bid. Here's what he said.
They called my offer unreasonable. And the market is basically saying loud and clear that the offer is reasonable. So we're going to get to the right spot no matter what.
So he sounds pretty confident that a deal is going to be made here. Is it a matter of just raising the prices, or does he have other advantages he isn't really talking about yet?
Let's make one thing clear. Lorenzo Gonçalves is always confident in getting something done. But to your point, I don't think it's a price question. I said earlier that I was having lunch with a steel market person who said, actually, the premium looks pretty good on this. But really at the heart of the matter, and I've discussed this with various sources yesterday and today, is the question of antitrust. If you put U.S. Steel and Cleveland-Cliffs under one roof, that's all of the integrated mill capacity in the United States. That's 100% of the iron ore that is produced here in the United States. That is also the dominant player of automotive-grade steel in the United States. You start kind of going through this, and you're talking to customers in the market already saying, hey, suddenly we're going from 2 major players to 1, and there's going to be serious questions. KeyBank's analyst had actually written last night, the OEMs for the automotive producers might actually have a problem with this themselves.
They might have a problem with that, but just to play devil's advocate here, I mean, we went from, I don't know, a dozen players to 2, not largely just because of economic conditions and the outsourcing of a lot of this stuff overseas. So is there maybe a case to be made that maybe if you have one bigger, stronger one, that provides more price control?
Absolutely, and I think Lorenzo said that to us earlier today, right? He said, listen, it'll make a national champion. We'll be the number 10 producer globally. It'll put us on par with the big Chinese producers. And he did know, all of them got that big by merging.
Yeah. Have you ever talked to that guy? He's very combative.
Lorenzo and I have spoken many times. Okay. Even before he was
Has he berated you too, the way he berated some of these analysts?
I think I've had a little bit easier, but listen, Lorenzo will always let me know what's on his mind when he has something to say.
That's for sure.
Definitely not a shy one. All right, Joe, thank you so much for bringing us your reporting. Joe Doe covers, of course, the steel companies and the commodity companies. Still ahead, Amazon's cloud business, well positioned for retail and AI dominance this year. That's the call from an analyst at Redburn. We're going to hear more about why the market is perhaps underestimating growth acceleration for AWS. This is Bloomberg.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The top names in business. business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Okta, a double upgrade today for the data management company to buy from sell. This over at Goldman Sachs, with the analysts expecting an inflection in subscribership growth. But this is only one subscription revenue bottoms in the second half of the year. Shares higher by about 1.5%. Next up, let's take a look at Urban Outfitters, getting the downgrade today to neutral from buy over at Citi. This is ahead of the retailer's quarterly report next week. While the analyst expects Urban to beat EPS estimates in the second quarter, he says market expectations are just way too high and sees limited upside for a stock that's already up 30% over the past 3 months alone. Finally, let's move on to Mosaic. Barclays cutting the fertilizer company to underweight. The price target staying at 40, but he has some concerns here about a continued price decline in potash, the main ingredient in fertilizer, as well as the effects of higher interest rates and gas pipeline restrictions that may continue into the second half of the year. Mosaic shares down about 3% on the day, and those are some of our top calls. We do want to stay in the sell side space and pivot to cloud computing. Redburn, positive about the outlook for Amazon and its cloud unit, saying that it's further prioritizing data-related services and artificial intelligence. Joining us now for his take is Alex Heisel. He's the head of software and cloud equity research over at Redburn Atlantic, recently raising his price target on Amazon by about $10 to $230 a share. All right, we know that space, the space here of cloud computing, Alex, is pretty healthy here, but give us a sense here as to why Amazon has an edge over some of its competitors.
Yeah, I think as a starting point, it's important to understand what really drove the deceleration of AWS, also compared to Azure and GCP. AWS really faced the perfect negative storm in terms of deceleration because organizations started to optimize existing workloads and really postpone as much as they can in terms of like new projects. And AWS simply, you can optimize more as well. So we've seen a much more significant deceleration. The second quarter, we've been quite confident going into the second quarter that we've seen the bottom because the pricing data we have collected from AWS has pointed to a re-acceleration in May and June. And I think what is important now that we see is that this optimization cycle is really coming to an end and organizations simply start new workloads again, and migration has also picked up. And on top of that, we have AI, and we consider AWS being best positioned because AWS is getting the lion's share of all the open source AI projects that we see in the market.
Do you feel that Andy Jassy and his deputies have sort of, I guess, articulated that AI strategy in a way that would provide a little bit more excitement, I guess, for the stock in the same way that we've seen with other companies like Alphabet and, of course, NVIDIA?
I think the narrative has really changed with the second quarter and the commentary from management where the positioning is. Because at the beginning of the year, there was the expectations that the market is dominated by OpenAI. In reality, the lion's share of generative AI is coming within the open source community. And this is where AWS is just best positioned. The integration with Hugging Face is exceptional. And also AWS is the only hyperscaler that is really vertically integrated. Also when it comes to AI chip, being it the Trainium that is really working well for the fine tuning and also the inferential for inference. So we believe that AWS is the most complete setup in terms of AI. And one other point to consider is to make AI work, we need a lot of other services to get data moving, get data preparing. And AWS has the best end-to-end data strategy. They dominate everything data related in the cloud. So the tide is lifting for them much more when it comes to AI adoption.
You know, after the NASDAQ 100's record run in the first half, it's hard to believe that investors could underestimate anything in tech land. Yet you say investors are underestimating the AI potential for AWS. Why specifically?
I think what we see in terms of like AI adoption, everything starts with consumer applications. It's quite straightforward. Then the second category would be like large enterprises that need a fully managed service that will be last. But what we see right now, where we have very strong momentum, is the open source community. And what we expect for AWS, we expect a re-acceleration from like 12% in the second quarter to 25% and above 30% in the fourth quarter. And it's simply, we're seeing a lot of these AI-related services lift growth for AWS. And on top of that, the company has recently announced the availability of the NVIDIA H100, which is going to be a big boost in the third quarter in terms of, and also in terms of fourth quarter, in terms of revenues for the company.
How much has AWS disclosed to you and analysts and the investor community versus you doing your own due diligence and trying to crunch the numbers here?
AWS disclosure is quite limited. I spend, I would say, at least half my day on AWS, using AWS. And for us, I think the most significant data points that we really found on AWS is like the spot pricing. It's basically the price what you pay for spare capacity. And what we have seen in our data points since the end of March till June, we have seen spot pricing coming up 30%. And that gave us really confidence into the second quarter. Overall disclosure is limited, and I think it takes a lot of time and effort to get your head around. And it's very likely, as the market has underestimated the deceleration, the re-acceleration will be much more significant. What we also, I think, should highlight is we have seen in 2020 AWS decelerating, but back then organizations have optimized, but they've rushed into the cloud. Now what we're seeing is there's definitely pent-up demand for new workloads, and we believe the market is really underestimating, and it's going to drive the stock from here.
All right, Alex, great to catch up with you. Alex Heisel there over at Redburn Atlantic, a closer look at Amazon and specifically Amazon Web Services. Coming up here on the program, a deeper dive into China and its ambitions here to make its currency the standard worldwide. Tim Massett, former CFTC chairman, stopping by to discuss some of those strides. That's coming up next in our Wall Street Week Daily segment. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
Welcome back to Bloomberg Markets to the Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, a lot of focus today on what's been going on in China. A lot of focus today on what's been going on with the dollar. And now these two worlds may be colliding.
They sure are. And as you and I both know, China's been working on a central bank digital currency for some time. But now word comes that they may have it up and running as early as the end of the year, along with some other countries and also the Bank for International Settlements. And the question is, what could that mean for the dollar? As you point out. To take us through that, we welcome now Tim Massett. He is former CFTC chairman and research fellow at the Harvard Kennedy School of Government. Tim, great to have you back on. Bring us up to speed on where that central bank digital currency is for China. We've talked about it before, but now we're seeing reports maybe by the end of the year. Is that plausible?
Well, they've launched it. They're rolling it out, and they've been at this for 10 years. But I think the more important immediate issue is that China and other countries want to develop international payment systems that don't depend on the dollar. China has a long way to go before the yuan would be a major international currency, but they are working, as you know, with the BIS and with Thailand, UAE, and Hong Kong on a platform that would allow those countries to use their respective central bank digital currencies as they develop them to basically avoid having to rely on dollar payment systems. And today the dollar is the key currency in international commerce. 90% of foreign exchange transactions involve the dollar. That's even if you're converting two other currencies. And most international payment transactions in some way or another connect to U.S. banks because they involve multiple steps. When a corporation in Hong Kong pays someone in the Middle East for oil, they each have a bank. Each of those banks has a correspondent bank. There may be another set of banks involved, and somewhere along the line, a U.S. bank is probably involved because dollars are involved. And that's given us enormous leverage, and we've used that to basically impose economic sanctions as an instrument of foreign policy. So I think the more immediate issue is all these countries who are looking at developing international payment mechanisms that don't depend on the dollar. Those are still a long ways away, but we need to pay attention to that and make sure we're looking at our own technology so that we stay in the game.
So, Tim, I can imagine where some countries might say we just as soon not have to go through U.S. banks because of the sanctions that have been used so liberally, I might say, by the U.S. government. On the other hand, would there be some countries who would be a little reluctant to have the central bank of China know exactly what their transactions were?
Absolutely they would. And again, these other countries are a long ways away from creating their own central bank digital currencies. But, the point is that international payments are slow and costly as it is. When you get multiple steps in the transaction and you get several banks involved and they're in different time zones and they have different operating hours and they're all doing these compliance checks, that just creates a lot of cost. So I think there's an interest, the U.S. should have an interest in trying to modernize that anyway, and that can also help maintain the dollar as the primary currency of international commerce.
Well, I'm sure you, as you know, Tim, a big part of this right now in terms of the dollar dominance is still tied to this idea of convertibility as well. It's all well and good if the Chinese are able to come up with something that's more efficient, but adoption, at least broad adoption, is still going to be, I guess, based on the final currency that people really want.
Absolutely it will be, and that's why I say, China is a long ways away from the yuan being, I think, a significant currency in international commerce. But, we still need to pay attention to these developments. Really, this is about the next stage of money, right? Yeah. We had money in the form of metal coins, and then we had paper notes, and then we have, electronic ledgers at banks. And now we're talking about digital tokens. And digital tokens can be an advance because they combine the actual movement of the message information, which today moves separately on SWIFT, for example, with the movement of the value, and they can be programmed. And that's also why a lot of countries are looking at this. So you're right, the U.S. dollar isn't threatened, but I think we do need to think about our technology so that, we have a seat at the table as these international systems are being talked about.
Well, since you went there, though, this gets into the whole idea of crypto, or at least what the promise of what crypto was supposed to be. There are a lot of people that would make the argument that maybe the threat isn't going to come from another government and its digital currency, but from something private, like some of the cryptocurrencies that have come and some have gone, of course.
Sure. I don't think it'll come from Bitcoin. I think, we could see a role for stable coins, meaning crypto tokens whose value is tied to a particular currency. We could see those develop. And, I support having a good regulatory framework so they can be developed. I'm not sure that they'll be that significant, but I think that's, one way in which we should be supporting the private sector to explore this. And, you know, full disclosure, I'm an advisor to PayPal, which is into this space. But my point is, we need a strong regulatory framework so at least the private sector can experiment with this in a way that doesn't create excessive risk.
Tim, are we any closer to that strong regulatory framework? Because you and I have been talking about this for a couple of years now, at least. People have sort of said there has to be some regulation of stablecoin, and yet it isn't there yet. Are we getting any closer?
Well, right now we have regulation at the state level, and that's what PayPal fully complied with. There are efforts to create a regulatory framework at the federal level, and the House Financial Services Committee did adopt a bill trying to move. Was hoping it would get more Democratic support, and I think there are ways to address the Democrats' concerns. They, you know, want to see a federal regime that makes sure that insofar as we have state chartering, as we do for banks, that there's still a good set of minimal federal standards. So I'm still hopeful. And I think, you know, all this activity in the space may encourage Congress to focus more on this.
Tim, as long as we're in the domestic regulatory framework, why don't we talk about the SEC and some sort of crypto ETFs? Because there are several applications in there now. One of them, by the way, involving BlackRock, which is a pretty respected organization last time I checked. Are we going to get some SEC approval of ETFs for cryptocurrencies?
Well, we'll have to see. I think there are about 9 applications pending. You know, the SEC has been concerned that the underlying market, the cash market for Bitcoin, still does not have a strong regulatory framework. And, you know, I got to agree with them. That's something else I've called for and supported. So I don't know that they're going to approve it yet, but we'll see. They have approved Bitcoin futures ETFs, frankly, because the CFTC approved the Bitcoin futures products. But I think the SEC is still concerned about, you know, the lack of strong regulatory oversight in that cash market.
But I am curious. I mean, to a certain extent, it's kind of a catch-22. Shouldn't the CFTC be the one sort of dictating what some of those regulatory guardrails are going to be?
Well, the CFTC only has authority over those futures. They don't have that spot market authority. And that's one thing that some of the proposals in Congress would give them. We just do not have today a federal agency with clear authority over the spot market for Bitcoin and Ethereum and other crypto tokens that, unless they're considered securities. And of course, there was some recent activity in that space where the SEC partly won and partly lost a case involving Ripple. So, you know, the law is still evolving, but we need a stronger regulatory framework. I've argued, let's not worry about whether it's a security or a commodity. Let's just create a framework that sets the basic standards that we need.
Tim, it's always so helpful to have you with us. Thanks so much for your time. That is Tim Massett. He's the former CFTC chairman. And I must say, one of the problems here is the SEC seems to be doing this by litigation rather than regulation, much less statutory authority, which is not an easy way to go. Tomorrow, we're going to be joined by Sam Palmisano. He's a former IBM CEO. And on Friday, we're going to be talking with Steve Ratner. He's Willett Advisors chairman and CEO. That will be at 6 p.m. Eastern time.
All right, our thanks there to David Weston. Let's toss it back to Scarlet Fu with some breaking news.
We have some breaking news from U.S. Steel. S-Mark has offered to buy the steelmaker for $35 a share in cash. This is an all-cash public offer for U.S. Steel at $35 a share. Of course, earlier today, we learned that U.S. Steel rejected Cleveland-Cliffs offer to buy the company at a $7.5 billion valuation, $7.25 billion valuation, calling it insufficient and unreasonable. So once again, S-Mark moving higher, U.S. Steel moving higher after S-Mark made an offer, and U.S. Steel gaining now 37% after that offer. Romain?
Definitely got to get some more details on this. Meanwhile, you go back to what's going on in the broader U.S. Markets here as we round out into the final hour of trading.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And very good afternoon, everybody. It is Monday, August 14th, 2023. Carol Masser, along with Tim Stenivek, live in our Bloomberg Interactive Brokers studio on YouTube and Bloomberg Originals. It's Monday.
Feels like it. Feels like it to me.
You should see. Tim comes over to my desk. He just has this look of pain on his
Just the pain
face.
of a Monday. You guys have all been there.
Come on, you all know about Mondays.
Hey, we got a good program today, though.
We do. Another one, right? And we also have stocks up a little bit on low volume. I mean, I think finally, coming into the city, I'm like, it's not just working from home. It's like nobody's out there.
No, it's actually nice. I kind of enjoy these couple weeks of being in Brooklyn on the weekends and like nobody's around and you can go and do stuff.
Seats on the subway.
Yeah,
choices.
it's nice.
All right, so we're going to talk about the market trade, the 10-year yield moving up to its highest since November, real yield to its highest in 14 years. Yep, you heard that right. We're going to talk about that. We're also hearing just some little mentions of China contagion. So we're going to talk about all of that, Tim.
Yeah, we're also going to talk about the significance of the U.S. Treasury trade and filter through the flurry of headlines and concerns overnight. Speaking of China, Carol, and the Chinese property market and its financial impact.
Absolutely. Continues to come out with news stories, and now we're starting to see it impact maybe the fringes of the Chinese financial sector. So we'll get into that in just a moment. We're also going to, a possible deal in the steel industry. And we just saw a headline cross because it sounds like there's a battle on for U.S. Steel.
Yeah, S-Mark reporting an all-cash public offer for U.S. Steel shares. We're going to get the latest with Joe Doe in just a few minutes, who hopefully has time.
Steel? I thought we were a chip
What's
world.
old is new again.
I thought we're living in a chip world.
Are you driving a car made of chips?
Not yet.
I'm just wondering.
Well, yes, I am, actually.
You are. The entire thing is made of chips.
A lot of steel there, too. We're going to talk about that. And if you want a new Apple Watch, I so do.
You have the original Apple Watch, don't you?
The second.
The second one? I can't believe it still works.
The battery barely works. I just keep forgetting. My husband keeps going, yeah, it's on.
You're wearing it.
Wait. Nope, the battery's gone. And my husband's like, go replace it. But every time I go to do it, I'm like, wait, Mark Gurman says there's another one coming.
Another one? Well, that's the question. He's going to talk about the one coming out or being announced in September. But the real question is what happens in 2024, 2025?
Do I have to wait now another full 12
Yes,
months, maybe even 24? All right. Also, are you rich? Tim,
Hey, that's a personal question.
Tim comes over. Did you do the survey? Come on, Carol, put in your salary.
I said, Carol, just open this article, type in your salary right there. You know, transparency, and it'll tell you if you're rich.
I'm like, go away, Stenivek. Go away, Stenivek. All right, don't go away, though. You who are listening and watching Bloomberg Business Week, because right now we're going to head over to our TV colleagues, talk about the trade. Countdown to the close. It starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Masser and Tim Stenivek. Welcome to our audiences across our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. A modest open here in U.S. equity markets, Carol Masser. Modest gains right now here as we march towards the close.
Yeah, what a wacky day in August. Again, and we're talking about, multiple offers for a steel company. Who'd have thunk, right? That old economy type of industry. Anyway, we'll talk about that